To see which piece of data this week the market reacts most to.
Yeah, and the question, as I say, being at what point did the savings run out?
Yeah. And does that start to show up in the spending numbers? The employment story was last week. This week it's about spending and inflation. Those two, in some ways, going to be impacting each other quite significantly. Right, here we go. European markets expected to open. I don't mean to downplay today's session because it is going to be exciting, and there are going to be some single stocks that we're going to be watching out for. But nevertheless, the real story kind of progresses. So, as I say, we've lined up some really big interviews for you over the next 24 hours. So, in terms of the early indications, and I'm dealing just with points here right now, Novo Nordisk out of the gate quite strongly. ASML is up as well. There's a fantastic piece on the Bloomberg Terminal talking about the chip investment that we're seeing globally at the moment. ASML is a big picture, the big piece of that. And here we go. I'm waiting to see, at the moment, I'm seeing Vestas up. I just want to double check that, but it looks like Vestas is going to be a big gainer this morning, despite what we heard from Donald Trump. So maybe actually that early read that Donald Trump were he to become president would be negative for the wind sector doesn't seem to be holding up, because at the moment I've got Vestas up by 3.3%.
Yeah, 3.4% right now on Vestas. They have, of course, above and beyond the Trump story, have struggled in terms of input prices and in terms of ensuring that there is that demand across wind energy. Some of those companies started to see a bit of an improvement. But yes, in the session today, Vestas one of your big gainers so far. We watch as well the mining space, given that copper and iron ore had a bit of a lift. You maybe tie that to expectations that could be more fiscal stimulus coming through from China, with, of course, those ultra-long bonds, 20, 30 and 50 year. But the basic resources sector is actually currently down around 0.3%.
I'm fascinated. It's quite a decent. This is a big gap higher for Vestas first thing this morning, and this stock has been climbing. The stock is up by nearly 10% over the last 5 days. So that captures some of the earnings numbers as well that we saw last week. But a really quite chunky gap higher first thing this morning. That's beginning to unwind a little bit, but clearly the market's not listening to Donald Trump.
Yeah, in terms of sectors on the move at the open, travel and leisure, the biggest gainer, up 0.5%. Tech just behind it, up 0.3%. Bottom of the basket, though, as you say, Tom, basic resources this morning. It's the CAC 40 that's in the red, as well as the FTSE 100. The CAC down 0.1%. Interesting backdrop for Emmanuel Macron's summit later. Choose France, he'll have to tell them.
Yes, well, of course, we're going to be hearing from the likes of Goldman Sachs' CEO, of course, David Solomon, is going to be speaking to us around 30 p.m. UK time. Here in the UK, the FTSE 100 currently at 8,427. So the FTSE 100 down about 0.1%. European stocks, of course, for the context, notching record highs on Friday as well. Over in Germany, the DAX is off 0.1%. Right now, guys, obsessed with the wind story. Are we just brushing off the fact that Trump has suddenly decided that he really cares about whales and birds? I don't know.
That was a little mystifying.
Incongruous, wasn't it?
I've also just been reminded that the Danish market was closed at the back end of last week, so maybe this could be some catch-up trade as well. So maybe that's the factor, that we're just playing catch-up a little bit in terms of what the other markets have been doing, and it's less maybe to do with what we're seeing from Donald Trump. The main story, though, continues to be what is happening with the narrative around the macro this week. The earnings story is beginning to wind down a little bit. We're still waiting for Nvidia and some other big stocks that are still going to be reporting numbers, but it's all about the sequencing around the central banks, who's going to go first and how big they're going to go. This is what Barnard Buwasia of UBS had to say a little bit earlier on in terms of how the market is positioned for that narrative.
I don't think the ECB is that mispriced at all. I think the ECB is being priced fairly correctly by the markets. If anything, I mean, there's a small possibility that the ECB doesn't move as quickly as what the markets are anticipating, and that's because wages are going to move much more slowly in this region. So growth is weaker in this region, but wages will come lower slowly because they're much more sticky. The labor markets in Europe are much more slow. There's greater inertia here. But I think the Fed is way more mispriced than the ECB.
Barnaby Asia, Chief Strategist at UBS Investment Bank, speaking to us a few minutes ago here on set. Let's carry on the conversation now. Joining us now, Ed Cole, Head of Multi-Strategy Equities at Man Group. Good morning.
Morning.
Let's kind of fold in the central bank story into the equity story. We've come through the earnings season, largely seems to have been sort of, on both sides of the Atlantic, a fairly decent one, certainly relative to expectations. But we're now trying to figure out if Europe continues with the momentum that it's seen recently, European equities. Is that down to continuation of earnings? Is that down to the ECB cutting rates? What is going to be the next catalyst, the next driver for European equities, and do they continue to outperform?
I mean, it's always earnings, and I think ultimately earnings is what drives equities in the medium term. Beating in a season is not a big thing. Yep. Companies guide down, right? So I think we should all be used to beats. For me, look, I think the outperformance of European equities is probably predicated on two things year to date. One is how spectacularly bearish everyone's been on Europe for so long, and I'd put UK in the same perspective. The kind of near certainty in Q4 last year that Europe was done. You know, there's such sort of structural problems in European economies that the outperformance was almost impossible. So that's kind of a consensus to kill. And then, of course, there's currencies. I think as we've started to see divergence in central bank policy expectations, and the dollar has clearly remained stronger, and we've had some weakness in euro and sterling, that's been pretty helpful to equity markets in these regions. So does that continue? In my mind, yes. Banu put it well. I think that in all likelihood, you know, there's at the moment we're kind of reasonably clear that Europe looks more sluggish economically. So the path towards European cuts looks reasonably secure. So, and then there's a question about the extent to which the Fed will cut. To my mind, that's, you know, something that we probably will see at some point this year. Okay. But I think
unpack that all for me. So where does that leave me in terms of this catch-up trade that Europe has had? It has been sluggish. Expectations got too bleak. Yeah. We're starting to close that gap. How much have we closed that gap? And if we do see central bank ECB cuts coming through and the Bank of England, does that move accelerate? Does the closing of the gap continue to accelerate?
Well, the long-term gap, no. I mean, like the long-term gap here is that the US is the most innovative economy in the world, stuffed full of the best companies in the world that trade at a much higher multiple. Are we going to close that in Europe? No, we're not. Tactically, you know, European equities have outperformed US year to date in a risk-on move. I think as long as risk appetite remains intact, that probably continues. My concerns are twofold. I guess near term, I have a particular concern near term, and then I have a bit of a concern, and then I have a concern a bit later this year. The near term concern is that we had a volatility shock that went through the market in April, which started actually, I can't prove this, but I don't think it started with the geopolitical concerns. It started on about April the 8th, when two-year treasuries blew out of their range. And to my mind, that put a load of volatility through cross-asset structure. And we saw a kind of breakdown in cross-asset volatility, which peaked just around the week after the geopolitical tension in the Middle East. That was clearly part of it. Typically, and we've had a very sharp bounce in risk appetite since then, but typically what happens is when you look at those moments when risk appetite breaks to the extent that it did, and there are various ways of measuring that, but sort of standardized measures of cross-asset volatility, when they break to the extent that they did in the middle of April, they very rarely form a V-shape back upwards. Typically what happens is you have a bottoming process where things, in fact, typically when we've gone back and looked at those data, they make lower lows. Now, that's just a sort of empirical observation, but to my mind, we're sitting here today with this big bounce in risk appetite off a pretty kind of difficult April environment. Lots of headwinds out there about what happens in policy in the near term. Volatility is incredibly low again, right? I mean, the VIX has collapsed, which perhaps suggests some complacency. And I think tactically, we need to be a little bit concerned about the fact that all of that vol and the de-gearing that started in April may not be done.
So how do you position? You still see, broadly top line, you still see further momentum for European stocks. How do you position to capitalise on that whilst also hedging against that potential complacency you're seeing when it comes to volatility?
Luckily, we're a hedge fund,
yes.
so that's our job. I think it really comes down to sort of thinking medium term about what's mispriced, where there are asymmetric opportunities. I mean, when we talk about inflation, we have to think about it on a global perspective. I think it's pretty clear that despite the stickiness we've seen, if we think about the US, which is, even if Europe is prepared to move earlier, which we saw a bit of that last week, ultimately we're all waiting to understand what happens with US inflation and what happens with the Fed. And the good news there, to my mind, is that the data we've seen out recently on the labour market is starting to suggest that things are loosening, that all of that tightness in the labour market is now easing. Critically, that's happening in wages, with average hourly earnings slowing. And just to put some numbers on that, you've gone from about 5% quarterly average hourly earning growth from second half of 2022 through to the end of 2023, about 5% year on year, down to about 3.5% year on year, year to date. That's a big step down, right? And that's showing us that the slowdown in job openings, that all of that tightness is now coming out of the labour market. So if we get beyond this tactical concern that I have, which empirically suggests we need to be a little bit worried right now, I think we're probably in an environment where what we've seen in the last few weeks, bad news is good news. So slowing labour market data, slowing economic data will be perceived to be good because it gives the Fed that room to kind of stay on the path it's been indicating since November. And that's probably a reasonable environment for equities. To your question about how do you play it, what looks interesting. For me, it's interesting. I was sitting there waiting to come on, and I was remembering that when I first came on here with Danny and Manus in November last year, my recommended trade was kind of rate-sensitive equities and some of the sort of better quality commercial real estate stocks. And I'm a stop clock. It hasn't changed. I think that if we have now a bit of a more confidence in a slowdown in inflation and a bit more of a bid for bond duration, that bond proxies are a really good place to be in the equity market. You have to be really specific about the types of companies you're buying, that, these sort of heavily leveraged businesses with bad balance sheets are not going to get bailed out. But if you can buy, good real estate companies in sensible places in the logistics supply chain, for example, that are on low LTVs with good growth in demand for what they do, then that looks like a good place, and I think you have a tailwind from bonds.
So it feels like so many of the assumptions from the start of the year have been smashed to pieces, punished by the markets. What's the biggest thing that we're getting wrong at the moment?
Well, I mean, I've been guilty of all of them, so probably what I've just said. And actually, I kind of mean that in a way, because I think one of the things that I've spotted, sort of trying to pick up consensus is important at the moment, because everything I think that seemed so obvious over the last 2 years has one by one, these things have been dismantled, right? These certainties have been picked apart. And, for the beginning of the year, I mentioned the certainty that Europe would underperform, and there was a certainty that China was broken. And I think that the new certainty that I've picked up, and I've been guilty of myself, is this kind of blanket assumption that US nominal GDP is growing at 5 to 6%. You just read it everywhere. Everyone says, well, US nominal GDP is growing at 5 to 6%, so 10-year bond yield should be at 5 to 6%. And I've been guilty of that myself, as I say, but I think that might be the new consensus. I think that might be the thing that over time we're going to start to see the CPI data moderating. That's going to be tested this week, of course. And that's the thing I'd be looking out for now, is that a bid for duration could be the surprise. One more thing, if I've got the time, is very briefly, is that possible with that slowdown, that as we get to the second half of this year and towards the end of this year, we're going to start talking about that landing again that we are not talking about now.
Yeah, we certainly feel like we're in a no landing environment at the moment. Ed, thanks for the honesty. Always appreciate it. Thank you very much indeed. Ed Cole, Head of Multi-Strategy Equities over at Man Group. Let's talk about some of those equities. A little bit of a catch-up trade maybe coming through in some of the Danish stocks this morning. But as you can see, we've got a bid into Novo Nordisk. It has been closed, that market, over the last few days. Elsewhere feels a little bit more quiet. Ferrari kind of maybe mulling those numbers over the last few days. A little bit back into chips. But LVMH, the luxury sector, looks like it's having a little bit of a better day. Let's dig into the details a bit more about what's happening this Monday with Joe Easton.
So we're going to start with AP Immerse. We've got a massive jump. It's the biggest gain this year. It was the biggest gain in 4 years for that stock when it was up about 10% at the open. As you've been mentioning, it is a bit of a catch-up trade. The Danish market was closed on Thursday and Friday, so all of those stocks seeing some movement. But during that time, we've also seen a rise in some key shipping rates, including in Shanghai, according to analysts over at Stifel. And there's another note out from Citi I was reading today, pointing to a potential $800 million gain in profit at Immerse, given the rising rates due to the Red Sea issues that we've seen. So those are all the factors at play for that one. Then in terms of those wind stocks you mentioned in the open there, but we did see a bit of movement. Where's Vestas? Vestas pretty much unchanged at the moment, but Ørsted coming down, Siemens Energy as well. Donald Trump, he's very concerned about whales and birds, isn't he? But also given that warning about the potential projects, and would he issue an executive order if he gets the nomination and then the White House, could he come down hard on that sector? Then we're looking at football. We mentioned in stocks to watch, we got this note out from Berenberg talking about the Champions League positivity and the more importance of that as the league gets bigger next season. Ajax is downgraded, but that one pretty much unchanged at the moment. Juventus ticking higher. They do like Juventus, but are worried about the debt there. BVB is the one they really like, Borussia Dortmund, in the Champions League final. However, that one has risen a lot. We've got big games this week in the Premier League. Tom McKenzie will be wearing a Tottenham Hotspur shirt for the first time ever, given the game against Man City tomorrow. But we'll move over and look at earnings, because there are some big movers in this sector, even though we are looking at the more mid-cap, smaller companies at the moment. Diploma here in the UK and Prysmian, these are both in the electronic cables and components business. Prysmian is more in the energy sector, Diploma in construction. This one in the UK, that was up around 11% at the open. It's coming down to 5% now following their reports. Economy, this is your white goods, your dishwashers and fridges in Germany, doing pretty good numbers out of them. And K&S over in chemicals, that one is pretty much unchanged after their reports earlier today. One big mover to show you in the deal space is a massive jump. It's OX2. Now, this is also in wind. It's renewable energy, so sticking on that theme, we've been looking at them. Look at that one. It's up 42%. They got a takeover bid from EQT, the publicly traded private equity firm. That one actually ticking very slightly high, but 42%. We're not going to beat that today, are we? Finally, on a morning call, BAE Systems. This is an interesting one. It is, of course, a defence supplier. Finally, a downgrade. Most people love these defence stocks, but that one is cut at Bank of America. It's all due to valuation. It's doubled over the past couple of years. It's a massive mover, and that one is declining today as Bank of America books profits on BAE Systems in London.
Okay, down a little over 2% on the back of that downgrade. Joe Easton running through some of the stocks on the move for us and highlighting, of course, the gainer, the top gainer across these European markets, AP Immerse, of course, the shipping company, up just shy of 9%. Bottom of the list, Holcim, one of Anna Edwards' favourite stocks, cement maker. Cement maker. We do miss her. Holcim currently down a little over 3%.
If Anna's watching, just ignore Tom.
We do most of the time.
She loves a bit of cement. Infrastructure.
European cement.
Yeah.
Excellent. Concrete.
Yeah.
Excellent. The Maersk story, I think, is interesting as much as it's just a catch-up trade. So its main rivals have been rising over the last few days, but Maersk has been closed over the last couple of sessions, and as a result of which we're seeing that kind of catch-up. But it's interesting that Vestas gapped higher first thing this morning, but then has now sort of faded that move quite quickly, maybe on the back of this speech that Donald Trump gave. As you say, he's concerned about whales, he's concerned about birds.
He's long had an interest in marine life, hasn't he, and protecting those ecosystems.
Yes. I'm not sure where to go with that, but yes, I think Tom maybe had a little fun with us this morning. In terms of what else we got coming up, talking of fun, we've got some great interviews lined up. We need to be talking about the interview we've got coming up, of course, with the French president. He is going to be joining our editor-in-chief, John Micklethwaite, a little bit later on. The Goldman Sachs CEO, David Solomon, is going to be joining John Ferro as well. They're both going to be at the Choose France event, which is taking place in Versailles. But in Washington, we are also going to be speaking to the Treasury Secretary. That conversation, very much one you want to be paying attention to. Janet Yellen coming up on Bloomberg Television. What are we going to be talking about next? We're going to discuss the efforts to gain chip supremacy around the world. In some ways, this goes to this Choose France event as well, which is taking place today. But the battle for supremacy, obviously, is significant. Huge amounts of money being invested. How does China react to this as well? We'll talk about all of that next. This is Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Good morning. Happy Monday. This is Markets Today. 21 minutes into the trading session, you're seeing modest gains of about 0.1%, just shy of that on the European stock 600. Now, superpowers led by the US and the European Union have funneled nearly $81 billion into producing the next generation of semiconductors. It's part of an escalating, of course, global showdown with China for chip supremacy. Let's bring in Bloomberg's Gao Yuan in Singapore, one of the reporters on today's fantastic Big Take, which is really worthy of your time. Gao, who is leading the effort then to fund these chip firms?
Hey, nice to see you, Tom. Yes, of course, the U.S. is definitely in the lead because you may have remembered the Biden administration introduced the CHIPS Act in 2022, when the government introduced the $39 billion in investment in chip manufacturing sectors. And a lot of countries are actually following, including Japan, India, European Union, and of course, a big chunk of it coming from China, which is trying to develop their own technologies and make breakthroughs so that they can be dependent on their own chip technologies.
And it feels like there's a kind of ramping up of these efforts. So many countries funding domestic chip making. Why the recent interest? Is it just because we've got elections on the horizon?
I think more than that, because chips are the most critical components when you want to make all kinds of devices, from smartphones to airplanes to defense systems. So every country wants to develop their own technology know-how and probably give their own domestic technology a boost. That's essentially the biggest reason, especially when the time that everyone is on the verge of developing their own technologies, and when it comes to the companies that basically they are trying to do yes.
How big is the gap between China how big is the gap? Go-Yuan, how big is the gap between China and the United States right now? There seems to be conflicting information. Some are suggesting the gap is enormous, that the United States has a huge lead. Others suggesting that actually the Chinese are much closer in terms of performance than we originally thought.
Yes, the gap is pretty big, actually. We are talking about the generations, because China now is only able to make what we know 7-nanometer chips, but now with the help of Taiwanese companies like TSMC, the US can make 3, maybe 2. So that's the gap we're talking about. So China is pretty much lagged behind. And to answer the previous question, basically because everyone wants to control the chips so that they can have their own technologies, their own plan makers, their own smartphone makers. That's essentially why making their own chips is very important for all these countries.
Yuan, thank you very much indeed. As Tom says, a fantastic piece on what is happening with the global chips industry and the race that has accelerated post-pandemic to make sure that each individual country, each individual region has a footprint, a much bigger footprint than originally conceived. Find it on your Bloomberg terminal. Also, you can find on your Bloomberg terminal what is happening with these markets right now. Let's talk a little bit about what the sector story looks like and break down what these markets are doing this Monday morning as we await for the CPI data to drop a little bit later on. As you can see broadly, stocks, I think, are just basically hovering around the flat line. We are seeing very little movement today at a headline level. I suspect that continues throughout most of the day. We maybe see that maybe punctuated a little bit by the New York Fed data we're going to see a little later on consumer expectations around inflation. But it's when we get into PPI and CPI, Tuesday, Wednesday, guys, that it's going to be important. Powell speaks tomorrow in Amsterdam. Powell is going to be in Amsterdam tomorrow.
Yeah, before the CPI print, of course. And to what extent do you want to be putting bets on the table ahead of what we hear from Jay Powell and ahead of that inflation print? To your point, so something of a holding pattern as we look at European stocks up about 0.1%. As you were saying, travel and leisure, real estate near the top, construction down 0.4%. Lizzie.
Just a reminder of some of the amazing conversations we've got on the docket coming up. The French President Emmanuel Macron is going to speak exclusively to Bloomberg from the Choose France Summit. Catch that interview with our Editor-in-Chief, John Micklethwaite, at 6 p.m. London time. Before that, we'll also have an exclusive interview with the US Treasury Secretary Janet Yellen. That conversation kicking off at 3 p.m. UK time. We'll be back with plenty more. As you say, stocks trading sideways here in Europe. This is Bloomberg.
Names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want. with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
This is Markets Today. We're 30 minutes into the European trading day. Stocks kind of treading water at this point. The Stoxx 600 just higher, 0.1% at this point. Looks like they're going to keep treading water all the way until that US CPI print later in the week. But let's look at what else we've got coming up for you. Euro area finance ministers meeting in Brussels. We've got the Choose France summit today. Lots of interesting interviews coming out of there, including with the French President Emmanuel Macron. We have the final German CPI data as well. We have the Qatar Economic Forum starting in Doha. Interesting to hear about how the Middle East is going to react to that chip-making war we were just talking about there. Chinese earnings as well, coming out of Tencent and Alibaba on Wednesday. And then we get Euro area first quarter GDP. And in geopolitics, we've got the Russian President Vladimir Putin starting a 2-day visit to China. This after Xi did his own tour of Europe last week. Then on Thursday, as I say, in fact, on Wednesday, we have the US CPI print, and we have earnings from Walmart and Siemens as well. The NATO military chiefs meeting in Brussels on Friday, and of course, Chinese data. We've started with some today, but we've got property prices, retail sales, and industrial production all to be released. But guys, the highlight really of the week is the CPI print. It's the first of 2 inflation readings before the next Fed meeting.
And I think you combine that with retail sales as well. Very anecdotally, when I was in the US a couple of weeks ago, I think there's a link, obviously, between what's happening with the politics and that support for Trump, who is polling above Biden now in some of the key swing states, and the sentiment amongst communities. And very anecdotally, you know, you do pick up on that frustration around higher prices, and people are still obviously going out and shopping, and you've seen that in the most recent data year to date. But when that starts to collide, and when that starts to break down, you're going to have a bit of trading lower already. So you're going to get the Walmart earnings as well and retail data. And I think that may start to tell us a slightly more negative picture about.
You saw it in the University of Michigan data Friday. Basically, that encapsulated it really nicely. Consumer confidence has been dinged up. That number comes down really sharply. The inflation expectations component of that data shows a big pickup. The consumer's picking up on the inflation story. And that's why Wednesday, Thursday, that kind of positioning between US CPI and then the retail sales number the following day, I think, can be really important. And I wonder whether or not, which piece of data gives us the bigger reaction? If you get kind of the CPI comes in as expectations, but then you see retail sales rolling over aggressively, That's the U.S. economy. The consumer is the U.S. economy, and if there's any evidence of weakness, that's going to be a problem.
To your point, Tom, I don't know if it's all anecdotal, because there was actually a piece on the Terminal about how your political leanings are influencing your economic sentiment, and actually it looks like Republicans and Democrats are equally gloomy about the economy.
Let's bring in Emma Moriarty right now, investment manager at CG Asset Management. Emma, are we on the fringes of a stagflationary economy in the U.S.?
I think it's a good question. Obviously, Jerome Powell the other week came out and said there's no stag or no inflation. But I think we are at this turning point in the U.S. economy where, on one hand, all of the inflation data, and then we had the University of Michigan data last week, showed evidence of this higher for longer, much stickier inflation than people expect. But then, on the other hand, we've also had, the senior loan officer survey come out saying actually standards are tightening, demand's down. The San Francisco Fed put out a piece saying that actually households have probably used up all of their pandemic savings now, and we're starting to see potentially the beginnings of cracks in the labor market. So, probably the Fed's taking the right approach here with saying, well, we need to see a set of consistent data, because at the moment we've got a lot of data points pointing in different directions, and it does seem to be starting to create volatility.
How does the market pricing look to you around the Fed right now?
Well, I think the market pricing's come in somewhat. We're now sort of, while the Fed's dot plot had originally said 3 cuts for this year, pricing's moving into sort of 1 to 2 cuts. And given everything that's come out of the sort of slew of Fed speakers saying we need to see more consistent data, it looks like even if all the data do line up, there's probably only enough time left for 1 to 2 cuts this year in the absence of a major movement in the labor market.
So what am I doing? How do I invest around it? Is the market positioned correctly right now? Is it better positioned in Europe versus the United States? Is it easier to call Europe versus what is happening in the States? I'm fascinated at the moment that the volatility story seems to be in the States rather than over here. Europe seems like it's on rails for cuts at the moment.
Yeah, I think there's 2 aspects of the story. There's the rate side of the story and the currency side of the story. And so, in terms of do you want to be in, say, the euro or sterling versus the dollar, there are a lot of factors supporting dollar strength. And that's not just a rate story, that's also a sort of relative growth story. I think in terms of relative interest rates, the Bank of England and the ECB have been much clearer in signaling a sort of potential bias towards cutting or dovish pivot in the Bank of England's case. So, there has been just much more willingness to cut communicated by those central banks than the Fed, where people have been increasing and coming out and saying, well, we'll keep monetary policy here for as long as we need to.
But in terms of our understanding, we've been buffeted by narrative shifts all year. And I'm wondering if we're done with that. In Europe, it feels like a much more clear and easier to understand narrative than over in the United States. So the shocks continue to come from the United States versus Europe.
I mean, potentially. I think the Europe story may get a little bit more complicated. We've started in the sense that Europe had been a very clear story of tight monetary policy has been suppressing demand and inflation has been coming down. I think what we've now started to see, particularly in the German data, is something a bit like what's happening in the UK, where it's now this similar question on one level to what's going on in the US. Is everything about to reaccelerate again, particularly now that there's real wage growth? I think the US has the luxury of it's just had much stronger demand. And so the need for cut has been much less pressing.
And of course, in the UK, we did just have that little surprise on GDP on Friday. The UK now out of recession in the rearview mirror. Does that delay a June cut for you? Or what would it take to make a June cut not a fait accompli, as Andrew Bailey called it?
Yes, I mean, I think it definitely does potentially delay a June cut. I mean, if you look at the latest round of Bank of England forecasts that were put out, they were conditioned on this recession data. And obviously, while a lot of the move came in the trade balances rather than necessarily domestically driven demand, higher growth definitely does shift the dial, not just from a forecasting perspective, but also from, sitting in the central banker's seat, just giving a little more confidence that inflation is trending in the right direction.
It's interesting because not everyone would agree with you. They would say perhaps that GDP is backward-looking and there's more focus on inflation and services, wage growth instead. Yes. But also I want to ask you about QT and the impact on markets, because there's been a lot of concern about active bond sales putting markets on edge, and yet we didn't get an announcement. They've put it off until September. Is that responsible?
I think definitely. I mean, one of the messages that the bank and the Federal Reserve have been trying to get out is that they want bank rate or interest rates to be seen as the primary tool of monetary policy. So I think keeping the debate around sort of short-term interest rates front and center has probably been the right thing to do to drive home that piece of messaging.
Lizzie, I think it's really interesting because I asked the question for a reason, and that is there's this idea that the US is where the volatility. We don't know what the Fed's going to do, but in some ways, you've got this message coming through from the Bank of England and from the ECB to a certain extent that is we are going to cut rates. But as you point out, you've got this data that's starting to talk of a story that is of re-acceleration. Is there a danger that actually Europe provides the surprise because inflation comes back? And actually, this rate-cutting cycle may not be as aggressive as we think.
And it's not just that, it's the fact that Christine Lagarde and Andrew Bailey now have really put emphasis on this data. It's not just that they're saying they're data-dependent, it's that these specific data points are what we need to see to do a June cut. So I think you're going to see even more volatility over the next couple of months.
Well, where that leaves us in terms of our views around bonds versus equities then, Emma, because UBS's Bernard Boager was on here earlier and he said, look, it's clear for us that the preference is bonds versus equities right now. Would you align with that view? Where do you sit on that debate?
I think there are sort of pockets of value in a lot of different markets. I think definitely in the UK, equities in particular are now looking incredibly attractively valued, particularly where we are in the interest rate story and with a bit of positive news on growth. Whereas if you take a look at the gilt curve, it's probably still priced a little bit richly for how many cuts we actually expect to come. But, if you look into the US markets, very short-dated treasuries are now looking quite aggressively priced, and so there might be good value to be had there.
Okay, so maybe some value to be had in the short end, the front end of USTs, but gilt's looking a little rich in terms of what's expected from the BOE. What's your take on the earnings story? Obviously, we've been talking about that, but it was a pretty solid beat, of course, so far across S&P listed companies. Gains earnings are coming in about 8% above forecast or thereabouts. Where does it leave your view on which companies kind of the best kind of match fit businesses as we lead up into the next quarter? How has that adjusted your view, and where's the tech story in that?
Yeah, I mean, I think in some ways this is very linked to the wider US economic growth story, in terms of there's been a lot of commentary for some time that US equities valuations are looking extremely stretched, and when does the music stop on this? And probably it's the same time that the consumer starts to break. So
you think we're closer to that point?
I think we must be getting closer to that point. If you look at it from the perspective of, say, like the US household balance sheets, which are now looking in much worse position than they were this time a year ago, for example, we must be getting closer to that point, and therefore probably in the US would favor sort of value names over the growth names.
Okay, Emma Moriarty, thank you very much indeed, investment manager at CG Asset Management. Coming up, SoftBank reporting a second straight quarter of profitability. We're going to have more on the AI investment boom that has buoyed assets, including, of course, chip designer ARM, for which SoftBank has an 80% plus stake. More on that next. This is Bloomberg.
What are you most worried about in the global economy now? Is it the geopolitical environment, U.S.-China, Ukraine? Is it inability to pass the debt limit extension? What are you most worried about?
I think most of the time I would answer the same way, a financial crisis. As a human, I worry a lot about the Chinese invading Taiwan and World War III coming on. But in that case, I don't think whether you invest with David Rubenstein or Cliff Asness is the really big issue. So I think a financial crisis I worry about because they're very unpredictable. After the fact, everyone predicted them. But before the fact, they're not very predictable. I don't think anyone wants a financial crisis. You think you'll do well, and something happens that boomerangs, and you don't.
Well, as we talk, we've seen Silicon Valley Bank basically go under and have to be bought. And there are other banks that have some challenges. Are you worried about a banking crisis or not so much?
Worried enough to put it on my worry list. I have no special knowledge of banks, commercial real estate and banks that deal in that, maybe a more nerve-wracking place, how that shakes out in cities. So, yeah, those things worry me, but not especially more. I think even before SVB, I would have said financial crisis is a very low probability. When someone says their biggest worry, doesn't mean they think it's likely. It means they think it's possible and would be terrible.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Earnings season is here.
I know that was fast. It feels like it was only yesterday. First quarter earnings pivotal for the European story.
Bloomberg is first to break the numbers.
And the estimates coming through from Volvo.
Numbers out from L'Oreal. ASML earnings.
Coming up, more analysis.
With the smartest insights.
Our supply chains are actually very resilient.
Productivity has to grow. We stand to benefit from this environment.
Fantastic team breaking it all down for you.
Continuing coverage on Bloomberg. Context changes everything.
We're 45 minutes into European equity trading, and to be honest, at a headline level, nothing is happening because we are all waiting for the inflation data, which is going to be posted over the next few days in its various forms out of the United States. We get some inflation data out of Europe at the back end of the week as well. But nevertheless, we're basically waiting for this. Are you brave enough to take on a big position in front of that number? I think the headline numbers would seem to suggest that the market is going to be cautious on that. I suspect below the surface, maybe actually, given the asymmetry of the risk around this number, there may be some positions are being built. Well, we'll see those maybe develop over the next few days. In terms of the corporate news we have this morning, over the last half hour, we've been monitoring what's been happening with SoftBank. It's starting, the breakdown is currently kind of trickling onto our screens. Tom, what are we seeing?
So, second quarter profit for SoftBank. And again, the AI story is coming here through with a really big lift, particularly via ARM, for which it has a massive majority stake in that company, of course, IPO'd in the US, to much to the chagrin of many a politician here in the UK, with a gain of about 113% over that period since it listed for ARM in terms of the shares. So SoftBank benefiting certainly from that, and the CFO has been talking about that. Of course, the Vision Fund as well. Losses from the Vision Fund, though, still pretty pronounced. Again, top lines in terms of for the quarter, SoftBank net income coming in comfortably above the estimates. But let's get more of a breakdown and more analysis and bring in Alex Webb from Bloomberg Originals from what we've been seeing from SoftBank, what it tells us about that AI momentum and what it tells us about some of those big bets coming through from Masayoshi Son and the team there. Alex, what kind of stands out to you from these earnings?
I mean, the increasing reliance on ARM actually is quite interesting, given that there were various junctures where they thought actually, well, particularly when Elliott was involved at SoftBank, they were sort of saying, just get ARM off the balance sheet, right? Like at this stage, you're not really sure we see the advantages. That is not something that clearly they want to be doing just yet. It's still consolidated into their earnings. The net asset value, which we've also seen increase, presumably has benefited quite a lot from the bump that ARM saw. Presumably the end of the quarter, that's when we actually saw that have an effect. It's corrected a little bit down since then, particularly as investors have realized that maybe it's not quite the AI play we thought it was. But the company is really trying to increase its exposure to AI. You have to ask, are they picking the right time in the cycle? But we'll see that in the coming months.
In terms of what happens next, so ARM in some ways is a rearview mirror story. They've got cash on the balance sheet. What is the objective now for the fund?
Well, I mean, there's the fund and then there's SoftBank itself, right? Okay. And the Vision Fund is one thing. Vision Fund has not been doing brilliant. They've been selling down a lot of their stakes, as our colleagues reported, I think, just before the weekend, not least in Coupang, in DoorDash and others. If they are able to get this big AI play off the ground, which has been reported by us and some others, they're trying to get they develop their own competitor essentially to OpenAI, more like a competitor to NVIDIA, my apologies. If they can do that, that'll be fascinating, because NVIDIA has been doing this for 25 years, right? And now, if that's a success, and it is the moonshot that he's long been trying to do, then that could do a lot for them. And that's when actually you start playing well with ARM, and ARM could maybe ride the coattails of that, because ARM has exposure to AI, but basically in the sense that it designs chips that support the AI chips. It's not actually the AI chips themselves. So if you can find a way of playing nicely together, then there's a real sort of synergistic effect there.
Yeah, so what sort of things are we looking at as Masayoshi Son's pet interests of the moment? You know, we've been talking about ARM and how it had that lukewarm revenue forecast, the shares diving last week. Where are they looking next?
Well, I mean, it is that AI play, right? It's how do you get the greater exposure to it without paying through the nose, right? Because at the moment, all AI valuations are massively inflated. GraphCore looks like a very fascinating opportunity right now. That's a British company that is just making chips, designing chips at least, that are specialized towards AI. You would think that GraphCore right now would be having a really good time of things. We haven't seen evidence that that is the case. They've had a few issues, the suspicions that maybe it's harder to get the manufacturing capacity, given, of course, that NVIDIA and Apple and others are gobbling it all up at TSMC. So if they are able to somehow turn GraphCore into a success, that will be fascinating, because I think who was the investor? Sequoia had a big stake in GraphCore. They wrote down a lot of the value of that stake. So they're probably going to be getting GraphCore at not the exorbitant price that it might have been a few years ago. That does provide an opportunity if the technology is as good as everybody would, or as GraphCore wants you to think it is.
You're being very diplomatic about the challenges that GraphCore has faced, and maybe that's going to be a fire sale. But maybe, as you say, there's real intrinsic value there that SoftBank can use their massive balance sheet to extract. How much have they learned from the kind of failed bets on companies like WeWork? How much has that changed Masayoshi's thinking and the way that he allocates capital?
It certainly looks as though they're more interested in actually, technologies, right? Famously at WeWork, he said, you've got to be crazier than the person you're competing against. And the way that the kind of Vision Fund seemed to work was just let's put so much money in some of these companies that we outspend all the competition. That means that we end up as the only player in the space, whatever the given company is, and then at a certain point, presumably you can hike prices, and then you're an interesting, you can generate some healthy profitability. That didn't really work, and we saw a few other things in the way that they invested, and there were questions raised about, well, actually, is this new round really generating new value, or is it just helping the book value? There has been a certain amount of humility, I think, as a consequence of that, some acknowledgements that maybe they got some things wrong there. The Vision Fund 2 didn't really go anywhere. Now, when we think about this new push into AI, they are very much going for technology that exists, and if they can get these things we mentioned off the ground, some of the core underlying pieces of it.
Can you catch up in the AI business if you're not based in London, not based in Cambridge, not based in the United States, not based on the West Coast? How difficult is this to do outside of those big kind of AI spheres that exist at the moment? How concentrated is the talent, the skill set, and the ability, therefore, to catch up, making it harder for everybody else to do? I'm just kind of wondering how this race is developing. If you look at where does Japan sit in the AI story more broadly?
Yeah, I mean, don't forget China on that list. China's got quite an event. Yeah. But yeah, I think there's probably some truth to it. I think you don't want to say Japan has no AI talent, because it clearly does. Yeah. We've seen some differences, though, in terms of remote work has made a lot of these things easier, right? But I think it's more diffuse than in other new technology revolutions, right? There's a lot in Paris, right? So you're not just talking about London and San Francisco. You're talking about this sort of, whatever you call it, the Golden Triangle, London, Cambridge, Oxford. You've got San Francisco. You have some people like, actually, in other parts of the US. You have France. You have, of course, China. There are quite a lot of places you can play. And in SoftBank, it isn't restricted by Japan, right? It clearly plays in a lot of different markets. So I wouldn't overplay it. It is nonetheless true that there are some concentrations.
Okay. Alex Webb, we thank you. The latest on those SoftBank earnings, how they're playing out in the AI world more broadly. Better than expected net income in the March quarter, a second straight quarter of profitability. We'll have plenty more coming up today. We're going to be speaking exclusively to the French President Emmanuel Macron on trade, geopolitics, international investment, and you can hear that interview with John Micklethwaite, our editor-in-chief, at 6 p.m. UK time. We're also going to speak to the Goldman Sachs CEO, David Solomon, joining us for an exclusive conversation as he takes part in that Choose France summit. That conversation at 3:30 p.m. London time. It's going to be a fascinating summit, this one. Macron really trying to sweep up the investment from the 180 bosses joining him in the Palace of Versailles.
But I do wonder whether that AI story is going to be front and centre. It's interesting, over the last few years, it's really focused on Paris as a financial hub. I wonder whether there's more to it this time in terms of the AI story.
Real AI talent that comes out of the universities of France. And you see that with companies like Mistral, which is being fully supported, not financially, but rhetorically from the French government. And it won't be a surprise to see the bosses at Mistral at this event and featured prominently, because from the French state's perspective, that is an indicator of where they want to be headed. And so watching Mistral is going to be really interesting as well. They have that talent and they have the companies, and that company's raised hundreds of millions of dollars within about a 12-month time frame.
Yep. So maybe actually the narrative does change, because that event has certainly over the last few years felt like it's been a financial event.
Yeah.
And you can kind of understand why. We also got QEF coming up as well. We're going to hear from Janet Yellen a little bit later on as well.
Yeah, so Janet Yellen, really interesting in terms of the tariff prospects coming through from the US, but also the debt questions that remain, and she's kind of nodded to some of those in recent weeks. So that conversation with Anne-Marie Horden is happening as well later today. That will be really interesting. And on the Middle East then, the QEF, so the Qatar Economic Forum 2024, kicks off in Doha tomorrow. We're going to be speaking to a host of global political players, such as the Qatari, Polish and Malaysian prime ministers, the Saudi finance minister as well, and the governor of the Turkish Central Bank. And we're going to get more on those US-China relations, as we've touched on and flagged. The question marks about China's overcapacity. China says it doesn't have overcapacity issues. It says it's quote-unquote being overhyped. What will the Treasury Secretary, Janet Yellen, discuss and talk about when it comes to that question? That exclusive conversation then at 3 p.m. UK time, guys.
Which is fantastic, because we've got so much to listen to over the next 24 hours, 48 hours, as we start to build up towards that CPI print. Be interesting to. I think the French story is really interesting. I wonder where the focus is going to be. We're going to hear from David Solomon a little bit later on. The Yellen conversation as well. But ultimately, we are just marking time. We are waiting for that CPI print to come out Wednesday. That's what the market's on tenterhooks about.
Indeed, and are we going to see more of a reaction if it goes one way than the other?
Are we going to see some explanations, do you think, out of some of these Bank of England members about why they voted the way they voted?
I'd like to hear from Dave Ramsden, if he's listening. I'd like to know why he dissented for this time. And is he being punished by the governor for dissenting, or is he actually being the sacrificial lamb, a signal to the market?
Just a stalking horse, maybe, in terms of the policy that we are maybe looking for. So we've got Hugh Pill speaking a little bit later on as well. We'll be hearing from him. It is an absolutely action-packed week in terms of the interviews that we are going to be bringing you and some of the names that are going to be speaking this week. So all of that is going to be folded in to the data story that we're going to be watching so carefully. It kicks off a little bit later on today with the New York Fed inflation expectations survey. We then get into PPI, then get into CPI, then get into retail sales. It is a week that you're not going to want to take your eyes off. We've got it all covered. That is what the markets look like right now. We're waiting, we're watching. We're going to pick up with the pulse next. That wraps things up for us. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Excellence covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Doha, Qatar. We're here for the Qatar Economic Forum, which kicks off tomorrow. Now, here's what's coming up on today's program. President Biden is set to quadruple tariffs on Chinese EVs and sharply increase levies on other key industries as Washington's trade battle with Beijing actually intensifies. The Russian President Vladimir Putin replaces his long-serving defense minister, an unexpected changing of the guard more than 2 years into Moscow's invasion of Ukraine. And Emmanuel Macron's Choose France event is taking place today. Microsoft, Amazon, and others are set to unveil major investments. The French president will also join Bloomberg TV for an exclusive conversation a little bit later on today. Now, first thing is first, we have a lot of news to cover, but let's take a look at the European markets map. Now, I came in this morning, and the first thing I read was actually a brilliant John Author's piece saying, welcome to Inflation Week, because today, if you look at Europe, but also across the board, stocks are taking a little bit of a breather as investors are really waiting some key data this week that may cast light on the outlook for interest rates on both sides of the Atlantic. But the main focus will, of course, be on the U.S. Consumer price numbers due on Wednesday, after data last week pointed to an economy that is slowing amid some stubborn inflation. So let's do cross assets. We're always looking at treasuries to have a look at how some of these traders are positioning ahead of a big week when it comes to data. Look, first quarter GDP and unemployment data for the Euro region are also due out on Wednesday. So it's going to be a big week on Wednesday. You can see sterling on the back of the BOE last week, 125.22. And then a couple of other things I'd watch out for is we also had news from China that the country will sell ultra-long special bonds, and that's boosting sentiment after weak data from, of course, China over the weekend. So the Biden administration set to quadruple tariffs on Chinese electric vehicles and sharply increase levies for other key industries. Now, Bloomberg understands that EV tariffs will rise from just over 27% to more than 100%. Now, for more on all of this, we're joined by Craig Trudell, Bloomberg's Global Autos editor. Craig, thank you for joining us. I mean, this seems political theater. Is this trying to get votes in the U.S.? What does it actually mean in terms of Chinese EVs getting into the U.S.?
Yeah, this is a case of mostly symbolism of the fact that EVs, we have not seen a whole lot of Chinese electric vehicles make it into the U.S. Because, for that matter, the fact that the Trump administration, as you mentioned, had already increased tariffs on vehicles from China to 27.5%. So, I mean, that was really enough already to make a significant, sort of send a significant message that your vehicles are not welcome here. I do think that there was, by some measures, an ability to import into the U.S. and still be able to sort of, take that hit. we now see, that small gap completely closing. I think the level of sort of unity in Washington, it's the one thing that's sort of unifying both parties is really taking a tough stance on China, particularly with important industries like the car industry.
Craig, it feels like, or we had news that some may actually be exempt. I don't know if those are panels or anything like that, or it's just too soon to say, but how did Donald Trump react to the news over the weekend? Would he do more tariffs against EVs?
He was mocking. He said, isn't this nice? And referred to this idea of actually, this view that Biden should have done this years ago. I think that's interesting in light of the fact that, Biden kept in place Trump-era tariffs. I do think also he's been really hitting this idea of a possibility of Chinese manufacturers building in Mexico and sort of using Mexico as a sort of backdoor. And we've seen indications in recent months that while there was some interest among companies to do that, that essentially Mexico has kind of shut out Chinese manufacturers to some degree. So while he's talked about, taking Biden's 100% roughly rate and saying, I'm going to put 200% on cars coming in from Mexico, that's extremely theoretical. There's not any actual Chinese electric vehicle plants going up in Mexico and trying to import into the U.S. So this is very much, political theater and in keeping, with this announcement from the Biden administration being largely symbolic and sort of carving out, a tough stance.
But Craig, because overall, if you look at the supply of some of the EVs, but also aluminum, steel, and some of the other things that the administration has put tariffs on, it's very small. So it's not really about crushing the segment, right? Is it about delaying the entry into the U.S. market?
Yeah, I don't think that we're going to see Chinese, cars just making it into the U.S. generally. I think, even with respect to, if you were able to overcome a tariff rate as high as where Biden wants to take it, which is quite difficult to do. So I think there's even moves to try and kind of turn this into a national security issue, and the fact that electric vehicles tend to have cameras for crash avoidance systems and sort of on those grounds blocking electric vehicles. So I think we're going to see, this become, an example of the ways in which the world is very much bifurcating as, China versus the rest of the world and what's acceptable to various markets.
Craig, as always, thank you so much. Craig Trudell there, Bloomberg's Global Autos editor. Now, we'll have some really good interviews a little bit later on. We'll also hear more about the state of the U.S.-China relations and China's overcapacity issues from the U.S. Treasury Secretary Janet Yellen's exclusive interview with Bloomberg TV and radio is coming up a little bit later. Now, let's go to the markets with, again, a big week. It's inflation week. We also have tariffs and the like. We're joined by Trevor Greetham, Royal London Asset Management's head of multi-asset, and Bloomberg's Justina Lee. So thank you both for joining us. Trevor, let's start with you. It's inflation week, happy inflation week. How important are all those numbers coming from the U.S. to try and give us a glimpse of what happens to Fed's monetary policy?
Absolutely critical. At the moment, you've got the markets facing a bit of a summer tightrope where normally in the summer, the markets get more volatile, there's thin trading, people get very sort of anxious. And with inflation where it is right now, and with the Fed where it is right now, if you've got really strong economic activity over the summer, people would worry about rate hikes. And if you've got weak economic activity, people would worry about earnings. So what you really need to square the circle there is inflation to come in lower than expected so the Fed can cut rates, even if growth holds up. You don't want to say, good news, the Fed's cutting, bad news, the stock market's falling.
So what does that tell us, Justine, about what the markets are looking for? Again, we know these set of numbers are extremely important, especially the nuances that we've seen and dangers about the U.S. economy overheating. But are we going to see positioning in treasuries, but even something like gold ahead of the Wednesday CPI?
Yeah, I think those are some really important questions here, because if we look at what's been going on in the Treasury market, I mean, yields have fallen quite a bit with markets generally relieved that it doesn't seem like we're going to get another rate hike. But I think these numbers are really critical in the sense that, I mean, economists are expecting CPI to be generally like a tad kind of lower. But at the same time, we've kind of seen these contradictory signals. You know, on one hand, the labor market has seemingly been slowing. But at the same time, I mean, if you look at the inflationary indicators, I mean, those don't seem to be cooling at all. I mean, so how do we kind of reconcile that? Or could it be that a lot of the factors swaying inflation right now are just no longer related to the labor market?
Yeah, and Trevor, I think you're maybe one of the lonely voices putting out there. I think Larry Summers is saying that we could see a rate hike. Why has that been largely discounted? I mean, the mood of the markets is very clearly towards optimism that inflation has been tamed. So I don't know whether it's because the Fed overpromised in December and there's still the overhang of that, or whether the market is looking at a different set of numbers.
Well, I mean, if you look at the US economy, it's posted solid growth, really, throughout the last 3 or 4 years, and against expectations. People were expecting, after the pandemic, the interest rate shock, to see a recession. It hasn't happened because you've had a kind of rolling series of sectoral recessions. First of all, services, and then production, and housing. And what you're seeing at the moment is services are still strong, and production looks like it's recovering. And that could result in stronger activity, sticky inflation, and Fed rate hikes. I mean, certainly I would not rule that out. I do think the Fed wants to squeeze in a rate cut if they can. Don't expect a big series of rate cuts, though, unless you get a lot more weakness in the economy. If you look at the US unemployment rate, it's starting to trend higher. You have to squint your eyes a little bit, but it's still a very low unemployment rate, and that does create inflation risks in the labor market. And you've got a whole range of other, what we call spikeflation shocks out there, things like geopolitics, net zero, deglobalization. All of these things can result in one-off shocks to the price level, and that's what could bring inflation back. So I think the Fed doesn't want to kind of ease too soon and find themselves having to hike aggressively later, and that does limit the scope for rate cuts. We've been overweight stocks, underweight government bonds all year. We haven't changed that position. And I think the real sort of tightrope, as I referred to earlier, is that the way to get the Fed definitively to cut rates is unemployment rates to rise, and can the stock market weather that without wobbling?
Yeah, but and there's a number of problems, right, in all of this, because it's a set of data that doesn't always match what we've seen, and this could be because of where we are in the cycle, or just the fact that this is a different cycle. But we also need to factor the fact that, you know, the rising interest rates could have a lagging effect and could start impacting the economy. We know that the Fed, certainly Jay Powell likes the University of Michigan numbers, and if you look at expectations and assessment of current conditions, they're both dropping a little bit, Trevor. So what do you do with that number?
It's very mixed data, both on the inflation side, where you would expect inflation to start to kind of ease, and it might be sticky on the way down, but you would expect inflation to drop. I see more scope for that at the moment in Europe than in the US. On the other hand, the growth picture is a bit mixed as well. You've got some contradictory signals from things like consumer confidence, and the bit of the cycle that looked like it was accelerating 2 or 3 months ago, which was production. The more recent data from the purchasing manager surveys suggests that maybe that's actually petering out as well. So it's a really tricky one right now. And I think what it says is central banks are on hold. And when things become clearer, they'll be hiking or they'll be cutting. But hikes are definitely possible. If the economies just stabilize from here and production picks up, I think rate hikes are possible.
Justina, I mean, to Trevor's point, I mean, it does seem like we're in a fine balance, almost like a fine balance like we haven't had in the past. Is that fair? And what does it mean for money moving around right now?
Yeah, I mean, you raised a great point, which is obviously the question everyone's always asking is, are we going to see kind of a lagging effect with monetary policy, and that we're just going to be shocked kind of one day and seeing the effects feed through? You know, for instance, one factor in inflation that a lot of people are talking about is those high rents in the U.S., which just seem so sticky. But of course, that kind of tends to react a bit more slowly in that it doesn't really move until, you know, people kind of move around or they renegotiate their leases. And so that's sort of in the camp of, you know, maybe inflation looks sticky right now, but it should be coming down. And I think that kind of will have a lot of implications, you know, for currencies, for instance. We've seen the strong dollar for quite a while now, and also for equities, which kind of have been surfing this like Goldilocks environment.
Okay, thank you both for joining us. Justina Lee, of course, from Bloomberg, and Trevor Greetham from Royal London Asset Management stays with us. Now, coming up, we'll have plenty more from Qatar, Doha, much more. This is Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Welcome back, everyone. Now let's return to our discussion with Trevor Greetham from Royal London Asset Management. Trevor, thank you so much for sticking around. Now, we were talking before about, I guess, the dispersion or the fact that you have different kind of data points, and it's quite difficult to put them all as one. There's also extreme division in politics, especially in the U.S. Does it make it harder to understand what kind of economy you're dealing with? Does it seep through economists' expectations?
I think it will do. If you think about other polarized debates, like the Brexit debate in the UK, for example, one side looks for every bit of data to prove that Brexit's disastrous. The other side looks at every bit of data to say everything's fine. And economics isn't a perfect science. So you will get people interpreting the data in the US in the run-up to November's election the way they want to see it. But I'm just struck by the fact, do you remember the inauguration speech from Trump when he became president was all about, the wasteland of the American economy. And people were looking at each other going, which American economy? Because at that time, the data was actually quite strong. So I think for Trump specifically, it won't matter. He'll just say everything's a disaster, even if it isn't. But the data's enough, and there's enough mixed data out there to give some credence to that view.
I mean, Trevor, there are a number of questions also. If the Fed starts cutting, the same for the Bank of England. In previous cycles, we've always had, you start with a cut and then you continue cutting, even if you're very tentative. This feels different. Do we have a blueprint or a manuscript for what could happen in terms of you cut once and then you wait?
It does feel different. You mentioned the lags of monetary policy earlier on, and there is a refinance wall out there, which could mean that you get, financial sector problems piling up, and therefore one rate cut becomes 5 rate cuts. But it feels like this is such a different business cycle because of COVID and the sectoral recessions, which didn't overlap. It feels like the economy's actually got some robustness to it. So I'm in the camp at the moment that says probably we'll get the Fed to cut rates if the data on Wednesday is soft. Maybe they'll cut rates sometime this year. But I don't see it as the beginning of like 8 rate cuts. I think it's more a steadying the tiller. And then when we're back in the same position we were before, which is trying to read the data, what's happening with inflation, where is it basing? And are there any more shocks coming down the pipe, which means inflation goes back up again? And what the Fed really doesn't want to do is get caught in that early 1980s situation where they cut rates aggressively and then have to hike them again. You get a double-dip recession. They don't want to do that.
Trevor, the other really interesting central bank is, of course, the BOJ. We had news today that they were, cutting some of the bond buying. This is an irregular operation, but also, yen again, weaker. What can they do?
They can't do a lot, really, because everyone knows the inflation picture in Japan isn't that hot. It's very hard for them to suddenly come out and say this is the first of a series of rate hikes, or that we really mean it. So I think they're kind of in the lap of the gods, really. If the US economy is stronger than expected, the Fed doesn't cut very much or even starts hiking rates, then the yield spreads between the US and Japan will widen again, and the yen will weaken again. Intervention doesn't really cut the mustard unless you have a policy shift going along with it. And everyone knows Japan can't hike rates aggressively at the moment. They don't need to. So I think the risk is that if you do get a stronger than expected US, the dollar strengthens, the yen weakens again, which is why Japanese equities for us are like an anti-bond play. If you're worried about treasuries, you think interest rates could go higher, Japanese equities are doing well in that environment because the exporters are benefiting from the weak yen. You do have to be careful about the yen exposure. So if you're buying a futures contract, you don't get the currency. You can buy an exchange-traded fund, for example, that's hedging the yen. But if you can get that exposure, it's like an anti-bond. And in the scenario where the Fed's hiking, it should do you well.
Interesting. Trevor, as always, thank you so much for joining us. That was Trevor Greetham from Royal London Asset Management. Now, coming up, we'll have plenty more on corporates. SoftBank reporting a second straight quarter of profitability. We'll have more on the AI boom that has buoyed assets, including chip designer ARM. This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities
could face bigger challenges.
Was going to keep rain World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome back, everyone. Now, Amazon, Microsoft, Pfizer, and Morgan Stanley are among the companies poised to boost their presence in France. Now, a flurry of new foreign investments will be unveiled today, amounting to almost 15 billion euros. Now, President Emmanuel Macron is hosting 180 chief executives this week in a push to reindustrialize France and make it a financial hub for the post-Brexit EU. Well, President Macron will speak exclusively to Bloomberg from the Choose France Summit. That interview with our very own John Micklethwaite, our editor-in-chief, and that's at 6 p.m. UK time. You don't want to miss it. The Goldman Sachs chief executive, David Solomon, will also join us for an exclusive interview as he takes part in the Choose France Summit. That conversation starts at 3:30 p.m. UK time. Now, onto SoftBank, and it's reported a second straight quarter of profitability. The Japanese tech giant has benefited from an AI investment boom, which has buoyed assets like ARM. Well, let's bring in Bloomberg's Alex Webb. Alex, what's your main takeaway from this? So is it the software earnings or the fact that now they're sitting on so much cash that we're just wondering what they'll do with it next?
Well, I think it shows you actually how dependent they are on ARM. Even though ARM has now been listed in the US, it remains consolidated within SoftBank's earnings. They still own considerably more than 50% of the equity. The question now, and this is the thing they're trying to play up, is like how they benefit from this AI boom. ARM actually did pretty well at the end of the quarter, at the end of March, but actually since then they had slightly soft earnings and the share price has suffered as a consequence. People are sort of realizing with ARM that it's not quite the AI play that they would have you believe. Nikkei reported yesterday, in fact, that ARM is trying to have an AI product in the new year, but it's still very early stages in that, and there's a lot more they can do.
So how will their investments change, Alex? I know they've also wound down some of their investments. Do we have any, how are they going to take advantage of this change?
Yeah, I mean, it's really about trying to increase their exposure to AI. It's interesting, it's an interesting time to do it because we're presumably very much at the top of the cycle. The valuations in the AI space are pretty punchy, so how they get value there is interesting. The GraphCore deal, which has been reported that they're in talks to acquire GraphCore. Now, that is a company that designs chips specifically for AI. If they can make that happen at a knockdown price and the tech is good, that's a good on-ramp.
Alex, thanks so much. Alex Webb there from Bloomberg Originals. Coming up, we have a full roundup of news from the Middle East. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, created, when you're solving a problem that's real for you and therefore real for the consumer.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is Bloomberg.
President Biden is set to quadruple tariffs on Chinese EVs and sharply increase levies on other key industries as Washington's trade battle with Beijing intensifies. Russian President Vladimir Putin replaces his long-serving defense minister on unexpected changing of the guard more than 2 years into Moscow's invasion of Ukraine. And Emmanuel Macron's Choose France event taking place today. Microsoft, Amazon, and others are set to unveil major investments. The French president will join Bloomberg TV for an exclusive conversation later today. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Doha for Qatar Economic Forum. Now, the Russian president, Vladimir Putin, has replaced his long-serving defense minister with his former economy aide. Now, the surprise cabinet reshuffle signals a focus on growing the Russian economy more than 2 years after the invasion of Ukraine. Well, for more on all of this, let's go straight to Sylvia Westall, Bloomberg's managing editor for economy and government. Sylvia, thank you so much for joining us. Now, this comes a couple of days after President Putin was sworn in again. What does it tell us of how the economy and, of course, the war efforts will shift?
Sure. I mean, I think the reshuffle and the choices perhaps signal some displeasure from Putin at how the war has gone on. If you remember back to the start of the invasion of Ukraine, Russia boasted it would be over quite quickly. And obviously we're here, things are still grinding on the ground. And Russia's had to completely recalibrate its economy in response to the need for funding the war and also to adapt to these sweeping sanctions. And in some ways, that's actually Russia's managed to do that quite effectively. If you look at now his pick of this close aide and a trained economist in this role, it does signal that there's sort of a focus now on how to keep this war economy going, how to make spending and other elements more efficient and able to have a kind of more sustainable front line as Russia pushes onwards in its invasion now in Ukraine.
So, Sylvia, what do we actually know about Andrei Beluzov, this new defense minister? As you're saying, he's an economist by training. Is this more the purse guy, the money guy in the war efforts, and is it going to be less strategic than the previous defense minister?
Well, he's definitely not a military man. It's clear that, you know, the military analysis and the way in which it's being formulated is very much being directed from the top with other individuals in Russia. He's seen more as someone that will bring in kind of efficiency to the spending and the ways in which things operate. You know, I think perhaps the sort of surprise, it perhaps wasn't a surprise that Putin shook things up and that he replaced his former defense minister Shoigu, who had been kind of under pressure over the war. But what's quite interesting is this pick here, and we'll be finding out more about him. I think, you know, it does signal this sense that the economy is very much coming into focus, and that's also important in the lead up to Putin's trip to China, where he's obviously going to meet one of his most important allies in sustaining that war economy and the importance of trade with China that's kept Russia afloat in many ways.
Sylvia, thank you so much. As always, Sylvia Westall, there, Bloomberg's managing editor for the economy and government. Now, the U.S. Secretary of State, Anthony Blinken, says Israel risks fueling Hamas insurgency in post-war Gaza. It's the latest warning in a steady escalation of U.S. concern about Israel's conduct in its fights against Hamas. Well, for more on all of this, we're joined by Leslie Vinjamuri, director of the U.S. and Americas program at Chatham House. Leslie, as always, thank you so much for joining us. It's unclear where this conflict ends and how many more loss of life there will be. Like, how do you see the next couple of months evolving?
Well, right now we're at a moment of urgency for those over 1 million Palestinians in Rafah. And the problem, as you rightly signaled, is that it's very difficult to think about the day after the plan for governance in Gaza when the world is facing such a critical moment. And we're seeing the U.S. begin to, at least at the level of the words that are chosen, put slightly more leverage on Israel, still demanding that the hostages be returned, that Hamas return those hostages, and trying quietly to continue those talks. But it seems to be at a standstill, with Netanyahu continuing to tell Palestinians to evacuate. And as we all know, from an area where there's really nowhere to go, where humanitarian assistance has been blocked. And so it is a crisis moment. And you know, Blinken and Biden are both getting it from all sides. Many people seeing the pressure on Israel to being very insignificant at best, having little, if any, impact. And, you know, to the extent to which those military weapons will really be held back is unclear. Some people think the report that came out was too, didn't really draw a hard enough line and chose its words too carefully. And others think that the right thing to do right now is to be quiet, to exercise quiet diplomacy, quiet pressure on Israel, because these overt words are simply playing into the hands of Hamas and other partners and other adversaries in the region. These are really complex decisions to make. I think the U.S. is trying to put pressure on all sides, but the reality is that those people on the ground, this is potentially a humanitarian crisis, a loss of life, unlike we have seen in many years in the Middle East, and it is truly extraordinary, Leslie, in its scale.
Are you surprised? I mean, the tone in which the U.S. is now talking about the conflict and warning Israel about what will happen if they really, you know, do the incursion into Rafah. I mean, it's a change of tone. Were you expecting this to come quicker? Can they go even harder? Or, as you seem to be intimating, this actually makes no difference and could be counterproductive?
Well, it is a change of tone. I think it's a change of tone that many people have wanted to see for a long time. We know that President Biden has been pursuing a strategy of holding Israel close. He believes in the state of Israel and its rightful, its right to provide for its own security, to get the hostages back, to defeat the threat that Hamas presents. But there's been a feeling and the signal from the administration that pressure on Israel has been quiet. It's been private. So the shift now is that it's in the public domain. But it's really, for many people, given the scale of the threat to the loss of life of Palestinians that is presented right now, it's simply too little. And many people are concerned that it could be too late. But again, the job of the U.S. right now, in part, is to put leverage and pressure on all sides, on Hamas, on Israel, and on other parties that have an ability to influence either of those two sides. And so it's a tricky, it's a tricky position. And as we know, Biden is facing pressure from all sides domestically in an election year where the Republican Party is, quite frankly, outraged at the words that Secretary Blinken and President Biden have chosen in recent days, and where we've seen what's happening across college campuses, where younger generations are really taking a different stand on Israel, wanting the U.S. administration to put more pressure on Israel to exercise restraint. But again, the real crisis is potentially and is in Gaza, and the administration also right now, I think, is trying, but many people feel, and probably not hard enough, as we can see, to get humanitarian supplies. That really is the urgency of the moment. The strategy and the need for a strategic resolution to the conflict really feels very far off right now.
Leslie, I also wanted to talk to you about these extra tariffs that President Biden is looking to impose on China. How much of this is symbolic and actually all about politics? Because a lot of these sectors, these targeted sectors, don't really rely on U.S. consumers, so they haven't really penetrated the U.S. market.
That's right. The U.S. is not importing electric vehicles at this point in time, and that is symbolic. But there's an effort, I think, also to affect prices beyond America's border. The administration has been, as I understand it, preparing these for a very long time. is trying to be very targeted and very careful in the way that it exercises them. It's clearly demonstrating that it will be tough on China and that it will focus very much on trying to give advantage to that part of the economy, especially the climate and renewable sector that the president has been trying to invest in through his climate plan, the Inflation Reduction Act. And of course, the fact that this is an election year really matters, but we expect to see an announcement of these tomorrow. Many of them are symbolic, but again, symbolism is important at a time like this. But there is a global market in which these tariffs are also being exercised.
So, Leslie, we're 6 months away from the election. I mean, is it about being different to President Trump, but at the same time making sure that actually, you know, that Trump cannot go after Biden on China? So what do they deliver? Like, what are the main differentiating points that we'll hear from, you know, both candidates over and over?
I think the Biden administration, yes, clearly believes in and wishes to be strong on China, but in a more measured and targeted way, saying, you know, and we've just seen, right? John Podesta has been negotiating and in talks with his Chinese counterpart to try and drive forward a positive agenda on cooperating, on reducing emissions, on the climate agenda, more specifically in the run-up to the next COP. So the administration, at some level, is doing what it always said it would do, which is to try and compete and cooperate with China, but it's doing in a tougher way. And the timing of this announcement clearly important for signaling not only at the national level generally to Americans that the Biden administration will take a tough stand on China, but also to domestic manufacturers that are seeking to invest in a targeted way in those areas that the administration is trying to create incentives as part of that green transformation. And this is really the area that differentiates the Biden administration from a potential second-term Trump administration, which is that focus on climate, both the positive agenda and the use of tariffs to try and move the needle on America's competitiveness, something that, you know, has a long way to go. And I think this administration is very aware of that.
Leslie, thank you so much. As always, Leslie Vinjamuri, the director of the U.S. and Americas program at Chatham House. Now, coming up, we'll have plenty more from the Middle East and from Doha. Ahead of the Qatar Economic Forum on Tuesday, we'll look at how the Gulf state is trying to broaden its economic and soft power across the globe. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Well, the Qatar Economic Forum, powered by Bloomberg, kicks off tomorrow here in Doha. The event will explore the issues driving global boardroom conversations and spotlight the Gulf's rising prominence. Now, 4 of the world's top 10 sovereign wealth funds are from the region. Their global investment portfolios now include American tech companies, English football clubs, and African mines, as they look to diversify beyond oil and gas to accumulate both hard and soft power. Now let's bring our chief emerging markets economist at Bloomberg Economics, Ziad Daoud. Ziad, thank you so much for joining us. First of all, if you look at Doha and Qatar, I mean, geopolitically, they're also a bit of a heavyweight as they do quite a lot of the negotiation between Israel, Hamas, and the West. How have they brokered this part?
Well, the views. I mean, basically, Qatar is an example that shows you don't need to be large as an economy or have a large population to have an influence and soft power. And yes, currently they are basically mediating between Hamas and Israel. They previously mediated between Taliban and the US. Potentially, maybe at some point, they'll also be in talks with Iran and so on. But that didn't start with the negotiations and mediation. I mean, back in the 1990s, before Qatar was extremely rich, they started Al Jazeera TV channel, which is extremely influential in the Arab world and still is, especially at times of war like the ones we're living in now. Qatar also hosted the World Cup in 2022, and that's another way to project soft power. So yes, it's currently using its wealth to punch above its weight and to mediate between global powers and regional conflicts. But that process has started a while ago, certainly in the mid-1990s, when it became more ambitious economically and politically.
So, Ziad, economically, again, this region is very oil-rich, and part of their story is basically, the transition here in Qatar. It's also going into LNG, but what they invest for in the future. I know it's a lot of the conversations that we'll have here at the Qatar Economic Forum. You have a flight a short while from now from joining us. What's the one question that you're trying to figure out for the region as they transition into an oil-less economy?
Well, I think there's a couple of things here. The first thing is that diversification away from oil becomes less urgent when oil prices are high. And oil prices have been high after the pandemic. They averaged $99 in 2022, and they're currently around $83 today, which is, relative to history, is relatively high. So I see less of an urgency to diversify in the region, and definitely you see that in Qatar, which now plans to expand its LNG production by 85% by 2030. And I think the second question that is important here is, as the 6 GCC countries are trying to diversify away from oil and gas, they're essentially targeting the same sectors. So they're all targeting tourism, financial centers, logistics, and basically high tech and AI and IT. And you wonder if the region needs so many tourism centers and so many financial centers and so many mega airports and mega ports. So this crowding out within the region, the fact that they're targeting similar sectors given the similar economic structure, is another question I'd love to ask, and whether that different countries can, approach different sectors differently rather than all hitting the same, basically, economic activities.
Ziad, what's also interesting is that because there's so many sovereign wealth funds with a lot of money, it's basically trying to figure out what they're putting their money in. And so that's sports, technology, and AI, which we'll also try and figure out here.
Yes, that's right. I mean, I think if you look at the GCC investments, and they've been vast, and they're obviously with high oil prices, they're accumulating a lot more. I think basically what they try to do is they try to do 3 things. They try to invest money in order to get an economic return that would replace oil revenues when they drop one day. So that's sort of the economic aspect to it. There is a soft power aspect to it, which is basically investing in the World Cup, investing in sports, investing in even rebranding. And we're seeing that in the case of Saudi Arabia, which is trying to move away from its old brand of a conservative country to a more open one. And the third aspect of it, you see the money also deployed towards political targets. And that's not new. There was a 1973 oil embargo that was using an economic power to achieve political targets. There was the bankrolling of the Iran-Iraq war in the 1980s with the GCC-funded Iraq. Again, that's using the wealth to achieve economic or political goals. And most recently, you've seen the example of the UAE big investments in Egypt, which, yes, it has a commercial side, but it's also probably likely have a political dimension to it as well.
Ziad, thank you so much for a terrific briefing. As always, Ziad Daoud there, Chief Emerging Markets Economist at Bloomberg Economics, on his way to Doha, Qatar. Now, we'll have a host of big interviews coming here from the Qatar Economic Forum, including the Qatari Prime Minister, of course, the Saudi Finance Minister, and the HSBC Chief Executive, Noel Quinn. Coming up, we'll also look at earnings. We take a look at some of the earnings due this week, including major European telecom shares. Our previews next, and this is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
general advice is continue to seek out companies or people that are maybe 1 stage or 2 stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Cut rates? No. We heard from Michelle Baumann on Friday saying that they need a series of prints to convince them that inflation is on the mend. And unless we get that, a rally in treasuries is going to be elusive.
Then really quickly, are you worried? We had University of Michigan numbers. I mean, they weren't that great. Is there, is it possible that actually the rate hikes are catching up?
Well, I think that the policy works with a lag, and there's definitely some inkling in the economy that things are cooling. Momentum is we are fast losing momentum. But where is that point where which will be the inflection point for the Fed is the question. And at this point, the economy is doing fine. It's not doing as much as it was doing earlier last year, but it's not sufficient yet for the Fed to be decreasing rates. And the inflection point in terms of the economy will come when the jobless numbers start going above 4%, and we are nowhere near those levels yet.
Ven, thank you so much. As always, Ven Ram there from Bloomberg MLive in Dubai. Coming up, our interview of the week, Emmanuel Macron, the Président Français. That's coming up, of course, later this evening. This is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Good morning from our global headquarters in New York. I'm Manish Krenny. Welcome to Bloomberg Brief. Let's set your agenda. Countdown to the US CPI. Will a cooling and the core embolden the risk-on rally? Washington's trade battle with Beijing intensifies. President Biden is set to quadruple some tariffs on Chinese goods this week. And choosing France, Microsoft, Amazon, and others unveil major investments. The French President Emmanuel Macron will join Bloomberg TV for an exclusive interview later today. We're counting down to that conversation between John Micklethwaite and Macron later today. More on that. Week 4 of a risk rally. We're going to grapple with a lot. The CPI, will the core cool sufficiently to reinvigorate and really hunker down on those rate cuts? The consumer sentiment, is it a 6-month low? You've got Cisco, Walmart, and Home Depot all coming through, so you're going to hear more about the consumer. Bottom of your screen is Alphabet. Now, Apple, we understand, may well announce a deal with OpenAI for ChatGPT. Who's the loser? Right now, the market thinks that Alphabet is the loser. Apple is bid by 0.8%. I said we're counting down to the CPI, and indeed 10-year bonds are flat at the moment, but the stakes are high. The last time we had CPI in April, it really spooked the market, up by 18 basis points. We're expecting a moderation for the first time in 6 months, 0.3% on the core. Now, when you throw a load of money at a market and you try to intervene and you stop the rot on dollar yen at the bottom of your screen, 155.87, that doesn't exactly work. So you trim back the amount of bonds that you're buying in the market. And this is a message to the market about trying to raise those rates. We're up, we've given a few ticks back at the moment, but we are shy of that 0.97, which was the November high. This is attempting to close the yield gap. Some people will say it is perhaps a little bit of a feeble attempt. We can debate that through the morning. So it is week 4 of the rally, as I've said to you, and investors are bracing for this CPI number report tomorrow, which could be a major test for the markets. There you go. There is your S&P 500. My guest this morning is senior multi-asset strategist over at State Street, Maria Waitman. Maria, good to see you. Week 4 of this rally. Consumer confidence is on its knees. Well, not on its knees. It's on a 6-month low. You got wages under pressure. We're spending less at Starbucks. Are you nervous? Are you anxious? Are you all in on this rally?
Good morning, Manas. Good morning, everyone. I think this rally, as a lot of things in U.S. economy, is kind of 2 tiers. So we have some companies that still able to generate strong profits. They often larger cap companies. They often have very, very strong balance sheets. They tend to serve maybe slightly more affluent consumer. Those companies doing well. That part of the economy is doing well. There is another part of the economy, the companies with tighter margins, smaller companies selling to kind of lower and maybe even middle-class consumer that beginning to struggle and showing cracks, like you're mentioning, like Starbucks and McDonald's of this world. So I think it's very much depends where you're looking. I mean, fortunately, large cap companies, mega caps doing great, so that's supporting index overall, but details are less encouraging.
Do you think we're running into some kind of an exhaustive point? And I asked you that question. I mean, we've had this rally in bonds, we've had a rally in equities, but I was looking at what Academy have written over the weekend, and this is what Peter Cheer writes. I think we are near the end of a lower yield Fed put rally that has helped stocks creep higher on anemic volumes. And this goes to the concept, Maria, of exceptionalism and what that exceptionalism is. Do you think there is some sense of exhaustion in the equity market?
Again, as I said, part of the equity markets are really struggling, and part of the equity markets have been supported by a kind of rate environment, and that rate environment is, I mean, I think we are more in the camp of higher for longer. So we're not kind of expecting immediate help from the Fed. I mean, thankfully, I mean, Chairman Powell kind of ruled out hikes, so that's great. But again, like, what's next? And cuts are maybe not imminent, and when earnings are not doing as amazingly as lots of people hoped, that's a problem. And as I said, I mean, my favorite stat from earnings season so far was, okay, overall earnings are growing and ahead of expectations, but all of this growth comes from mega cap tech, while S&P X Tech is actually seeing earnings contraction, and for, I think, 5th consecutive quarter. So that's not a great support. If you don't think that rates are cut immediately by a lot, I mean, that's not fantastic. So that part of the market I'm really, really worried about.
But yet your mantra has been to have a barbell approach, to quote you from the last time you were with Danny and I, which was on the two tails. You wanted cash and you wanted tech. So I take it then you're being even more segregationist about the tech. In other words, you are even more entrenched in big tech. And if I look at big tech, you look at the dividends as well. Meta 50 cents, Alphabet 20 cents. So does that reinforce, does the dividend additional hook reinforce the barbell scenario for big tech for you?
Yeah, absolutely. And I mean, the reason tech is so willing and able to pay dividends is because their balance sheets are like fortresses. They're fantastically strong, and free cash generation is amazing. And that's not many companies in S&P that, or anywhere, that can really afford that and can make that. I mean, often dividends is kind of your signaling idea, right? So that I'm very strong. And I mean, tech is really, really signaling that they're very strong. They're not really suffering under higher interest rates. And yes, consumer is slowing, and we're seeing cracks here and there, but not in tech.
No, definitely not. Give me your sense. I was rereading what Andrew Bailey had to say to the market, and I think it's very interesting. It's almost as if we're stepping into the unknown. So we're going to go into this world of where we're cutting rates perhaps without a cataclysmic event, either in the UK or in the US or in global banking. Historically slow cutting cycle. This is not 1998. This is not 2001. This is not 2008. Therefore, what I would ask you is, we're stepping into the unknown. We don't quite know what this cycle is going to look like. But if it is historically slow, how much more defensive do you want to become? I know where the barbell is for you, but is that the kind of slow minutia of cuts that you're expecting?
I mean, there are two kind of ways to answer this question. I mean, first of all, if central banks really take it very slow, I think there is a risk that we kind of create more and more problems, because as I was saying, is that there are some parts of the economies that desperately need cuts, and other parts are doing better. So on average, it's okay, we're going slow, which is not fantastic for the first part. But secondly, what I'm really interested in terms of equity market, so how defensive you want to be. So if you look at margins, and I think margins are really important right now, the thinnest margins, so the biggest decline in margins are in consumer staples and healthcare. So ultimately, your defensive sectors but they're really, really struggling right now. Or this kind of margin pressure is really hitting them because they find it very difficult to pass higher prices to consumer. And I think that's really important, so that you can't really go to your normal defensives in terms of equity allocation, because there is like a margin problem. So your defense in current market environment is really large caps versus small caps, as opposed to kind of sector tilts. And I hate to say, but all roads lead to tech again.
Maria, it's going to be when the dam cracks and you come on this TV and you say it's time to step out of cash and perhaps trim my tech allocation. You know, that's a red headline in itself. Let's just talk about some of the challenges in that broader market. You talk about the profitability in the broader market being challenged sequentially for a number of quarters. If Danny was here, I know she would be Judy Brown to ask you this. We're looking at the debt compilation in the Russell 2000. $832 billion worth of debt. 75% of that matures by 2029. Maybe this is the more factual reason why this equity market, the broader equity market, so desperately needs rate cuts, even if they are insurance rate cuts.
Yeah, absolutely, 100% agree with you. And I think this idea that equity markets were able to rally, say, last year, and lots of people expected recession last year, and it didn't happen. A lot of it comes from lots of companies and consumer really strengthening their balance sheet during kind of free money period, post-COVID, the extra liquidity. So lots of kind of refinancing has happened. And ultimately that again created, so I'm coming back to my kind of two-tier economy, two-tier stock market. Companies with strong balance sheet, asset owners, they're not really feeling the heat of those higher interest rates and tighter financial conditions, but not everyone in this camp. And I think large cap versus small cap, as I said, is the best kind of delineation in terms of equity market performance because smaller companies, their cost of borrowing has increased substantially. Their net interest expense is rising to close to decade high, while larger companies are still okay. So this kind of ability to finance that and refinance that is really, really important for that part of the economy.
Maria, great to get you with us. I'm still waiting for the change in the barbell. Maria Waitman there at State Street with her Monday morning market calls. Other stories trending on your Bloomberg terminal this Monday morning. Donald Trump pledges to double down on tax cuts. That's if he wins a second term as president. The presumed Republican nominee spoke at a rally on Saturday in New Jersey Shore. Part of his 2017 tax law are set to expire in 2025. He vowed a day-one order targeting offshore wind projects. Tesla's facing further protests at its factory in Germany, where the activists are trying to stop the expansion that would require razing part of the surrounding forest. Police say at least 16 people were arrested on Friday following actions including breaking into the airfield, damaging new Tesla vehicles, and blocking a road by the factory. Microsoft plans to spend $4.3 billion building cloud and AI infrastructure in France. Now, the announcement is part of President Emmanuel Macron's Choose France summit, which aims to attract foreign companies and make France a financial hub for the European Union. Amazon, Pfizer, and Morgan Stanley are among the companies poised to boost their presence in the country. And more efforts to support China's economy. The country will start selling its first batch of ultra-long bonds on Friday. It will issue 1 trillion yuan. That's the equivalent to $138 billion of 30-year bonds. This ends months of speculation over when the bonds will actually be rolled out. Coming up, President Biden gears up to hit China with quadruple tariffs. More on that story. And Bloomberg is live at Choose France Summit in Versailles. This hour, we'll speak to the CEO of Ontario Teachers Pension Plan. Joe Taylor joins me. That is at 10:30 Eastern. An exclusive interview with the Goldman Sachs CEO, David Solomon. Then the Bloomberg News Editor-in-Chief, John Micklethwaite, sits down for an exclusive conversation with the French President, Emmanuel Macron. You can catch that interview at 1 p.m. Eastern. Plus, we have more for you. The Treasury Secretary, Janet Yellen, is at 10 a.m. Eastern. Join us for a feast of interviews and news on Bloomberg, where context matters.
It's the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It is Bloomberg Brief. I'm Manus Cranny in New York, where President Biden is said to be looking to strengthen the U.S.'s stance against Chinese imports, quadrupling tariffs on electric vehicles made in the world's second largest economy. And this as Donald Trump responds. He warns that Chinese companies will try to build those cars in Mexico to avoid the tariffs, saying, quote, "I will put 200% tax on every car that comes in from those plants," and they're not going to do that. For more, let's get to Oliver Crook. He joins me to understand. Look, much has been made of this big banner headline about tariffs, Oliver, but I'm looking at what Terry Haynes wrote over the weekend. Biden's tariffs are noise. However, they do signal high geopolitical risk in the reshaping of the U.S. economy. Contextualize noise for me. Good morning.
That's right, and through that noise, Manus, it's the message that we're trying to perceive, which is, again, it may not be down to these EVs on themselves. So the headline, which we sort of had at the beginning of the end of last week, kind of scooped. You know, now we have the number. It's quadrupling the tariffs to 102%, basically, on EVs brought into the United States from China. Now, the reason that is a bit of noise is because the Chinese automakers are not targeting at all the U.S. market. They're really targeting the European market because they had this sort of fear of this sort of thing to happen. So, again, this noise that comes out of it and the sound that we get, the message we get from it, is that Biden is going to be very hard on China going into this election. What I think is interesting is what we do not yet have are the other targeted parts of industries where we're also expecting to have tariffs go into. We're going to get that probably a little bit later in the week, but we're talking about doubling, maybe tripling tariffs on other kinds of goods outside of that. And for the Biden administration, this is really a question of having your cake and eating it, being hard on certain parts of the Chinese exports without being hard on the part that really are key for American growth to continue to go forward into this election year.
Yeah, but to a certain extent, look, this is politics and symbolism. Steel and aluminium tariffs will probably increase, we understand as well. It's no irony lost. You're sitting in Brussels, and Europe has their own issue with China, and that was very apparent with Macron, von der Leyen, and Xi Jinping sitting around a table last week. I want to dig in a little bit more on the U.S. side here in terms of the response from Trump on the Biden initiative. I mean, again, very clearly a week of high politicking.
Yeah, I think for both of these candidates, you know, one obviously sitting president, the other hoping to be that, the winning issue for both of them is being tough on China, right? I think the difference you have a little bit with Biden and Trump is Biden's approach seems to be a little bit more targeted, but, you know, still pretty severe. I mean, Trump has talked about 60% tariffs on all Chinese goods across the board. As you were just mentioning in the intro there about cars that are built in Mexico getting a 200% tariff if they're sort of Chinese cars. I mean, this is also a fundamental point on NAFTA, right? And all of these trade agreements that you've got around the world, is that all going to get sort of blown up going into this because, you know, it's seen as sort of going around this? I mean, you had Xi Jinping here in Europe. He was in France. He was also in Hungary, Manus. Yep. What is going on in Hungary? They've got the huge battery supply chain, battery factory for the Chinese there. BYD is building a factory over there. And again, this is all part of reordering the global trade and manufacturing apparatus.
Okay, Oliver, thank you very much. Tracking the stories from the weekend, Oliver Crook. Over to Russia. President Putin reshuffles his defense and security team overnight as the troops advance in Ukraine's Kharkiv region in a new offensive. Mark Champion has been tracking the story. Mark, good to have you with me. So Vladimir Putin replaces a long-standing friend and defense minister with an economist. This is not exactly exceptional, but it's the moving of the chess pieces. It's one of the biggest reshuffles that we've seen in a number of years. Why now, and what exactly is he doing?
Yeah, well, the answer to why now is, you know, in part, whenever he's begun a new term, Putin has tended to have a big reshuffle of the government, and that is in part just to show that there is renewal at the top, even as he himself continues in power for now 2.5 decades. So it's partly just business as usual in a sense. But the fact that it was Shoigu, the defense minister, who was moved on, that's clearly about a war that is going better now. So Putin can afford to make these kinds of changes without it being seen as a recognition of failure. And yet the war has gone, objectively badly for Russia compared to what they would have expected, what everybody expected, even if now they have turned it around and are back on the sort of front foot on the offensive with the Ukrainians, outgunned, undermanned, and they are beginning to make some sort of a forward movement again.
Well, certainly as Putin's sworn in for his 5th term, people around the world are going to be keeping a close eye on other moves on the chessboard. I want to pivot to Washington with Secretary Blinken over the weekend, warning that Israel lacks a plan for shielding civilians in a post-war world for the U.S. to trust.
Israel's on the trajectory potentially to inherit an insurgency with many armed Hamas left, or if it leaves, a vacuum filled by chaos, filled by anarchy, and probably refilled by Hamas.
So this is all about the credibility of plans. Secretary Blinken, he had a phone call, didn't he, Mark, with the Israeli defense minister. That was over the weekend. To what extent was there progress? We understand 300,000 people have fled Rafah. That still leaves an estimated 700,000 in Rafah. What progress?
Well, I mean, that is the progress. The U.S. remains committed to its position that the Israelis should not be going into Rafah until civilians are out of the way. The Israelis remain committed to going in. And so there is a kind of clear blue water between the Biden administration and Prime Minister Netanyahu on this. But the U.S. position is, it really, if Israel goes in when there are all these civilians, the Israeli kind of explanation is, look, these are being civilians. It's not our fault. It is Hamas using them as human shields. The U.S. is basically saying, well, move them out the way then, and that has begun. And I think it's going to be interesting to see at what pace the Israelis go in and whether they are persuaded to allow more people out.
Mark, thank you. Mark Champion there, covering the very latest on Anthony Blinken's comments on the Hamas-Israel war. Join me. We'll take you through the front pages in just a moment. This is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to
be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
It's your Monday edition of Bloomberg Brief. I'm Manus Cranny in New York. So the headline is $1 trillion yuan worth of stimulus in the form of long-end bonds. How is that translating, by the way? That translates to the commodity market. You're seeing copper get a nice boost. Also, aluminium on the rise, up 0.8%, and crude up 0.4%. So what you have here is a real boost above 10,000 in the copper markets. You are just seeing a reversal of losses in aluminium as well, the lowest level in a month. So this stimulus really sort of manifesting itself potentially in the growth. The credit numbers over the weekend in April shrank to the least since 2017. Bond markets were counting down to CPI.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you're the first woman, as I understand it, the first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
multi-trillion dollar industry. There's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
This is Bloomberg.
From our global headquarters in New York, I'm Manus Cranny. Let's set your agenda. Countdown to the US CPI. Will a cooling core embolden the risk-on rally? And Washington's trade battle with Beijing intensifies. President Biden is set to quadruple some tariffs on Chinese goods this week. And choosing France, Microsoft, Amazon, and others unveil major investments. French President Emmanuel Macron will join Bloomberg TV for an exclusive interview later today. A very good morning. We're going into a week of high tension over what exactly will the tariffs be. Is it theater rather than actual pressure on the Chinese? Equities start 0.1% higher. I'll take anything at 529. So this is the start of a fourth week of a rally in equities. We just had Maria Waitman from State Street warning about margins. Anything beyond the Mag 7 is pressure. Will you get a disinflation, a deceleration in the core CPI? The last time we had the CPI over a month ago, we saw bonds ratchet higher by 18 basis points on the day. It was a little bit of a shock, and it jolted the market, to say the least. So you're looking at 10-year government bonds up. The number you got to focus on is plus 0.3%, down from 0.4% on the core. JGBs are treading water. There's an interesting dynamic for the Bank of Japan today as far as this is concerned. They've trimmed the amount of bonds that they're actually buying. So this is about a signal to try and cause 30-year paper at the highest level in decades. Now, you are trying to see the Bank of Japan under pressure from the government to close that yield gap, trying to put a floor in yen. It's having fairly limited impact at the moment. Now, look, I've mentioned the CPI to you. It will come tomorrow, and it's probably going to be the biggest test yet of the rally that started just over a month ago. That was when Powell signaled the central bank would not be hiking rates. Well, the Chicago Fed President Austin Goolsbee discussed his thoughts on inflation. This was Friday.
There isn't, at this time, much evidence, in my view, that inflation is stalling out at 3%. If you take a step back, what's happened is inflation went way up in the United States and in everywhere else in the world.
Stallflation, that's the debate. Our stagflation maybe even is a tail risk. Justina Lee joins me now. The question that I'm interested to know is how we're positioned. We've come back by 18 basis points. Yields have come down by 18 basis points in the month of May. How do you think we're positioned going into this release?
I think, yeah, like the drop in yields are reflected in the changes in positioning. I mean, if you look at, the official data on how speculators are positioned in Treasury futures, it does look like they've covered a lot of their shorts. And if you look at the JP Morgan survey of client positioning, they are turning long. And I think, that is reflected in the bond yields in that investors collectively seem to have breathed a sigh of relief after kind of the Fed indicated that they were at least not thinking about tightening. And so I think there really is a lot hanging on the inflation numbers that are going to come out this week.
So, as I said, the estimate is for 0.3%, down from 0.4%. Where does that leave us on a year-on-year basis, and how significant would a drop to 0.3% be?
Yeah, I think these sets of numbers are especially critical, kind of given the contradictory signals that we've been getting from the data lately. I mean, on one hand, we're seeing some signs of the labor market cooling, but on the other, I mean, all the inflationary indicators are still looking pretty hot. I mean, if you look at what kind of my colleague heard from, the chief U.S. economist at Deutsche Bank, he's saying that there's a bit of a dovish bias potentially in the reaction to the CPI numbers, in that he thinks investors will be happy to see any signs of progress on inflation. And if we get a sign of that, that could be a cue to buy more treasuries.
Okay, Justina, thank you very much. Yeah, the flamethrower, which is CPI. Let's see what it does to the bond market. Turning our attention over to tech this Monday morning. Apple has closed in on a deal, we understand, with OpenAI. This would be to use ChatGPT on your iPhone to help bring more AI features to your devices. Alex Webb is with me. So this is the big expectation in terms of AI on my next round of iPhone. How would that fit in?
Well, the way it fits into the iPhone is different from how it fits into the broader market as a whole. For Apple, it really is a big competitive threat because, of course, Android is the operating system with which the iPhone and iOS competes most intensely. That is developed by Google. Google has got a very sophisticated AI offering. So if people are going to continue buying iPhones, it needs to be able to compete with Google on that front. How this deal with ChatGPT looks, what exactly it entails, whether it's hardwired into Siri, for instance, we'll find that out presumably at WWDC in a few weeks' time. That's Apple's big developer conference. The one thing, though, you've got to remember is there have been a few AI devices that we've seen released. The reception for them, the reviews of them have been lukewarm, to say that at the very best. And everybody's saying, a lot of the reviews have said, well, what is this phone doing that I can't already do with a smartphone? So Apple does have that huge advantage.
Yeah, I think my favorite line in the story is, it's the biggest upgrade to Siri's 13-year history. So let's see what happens there. Can we talk about SoftBank? Because, again, more plans, more aggressive in AI is the narrative that's coming out. This is after reporting a second quarter profit and a surge in the value of assets, including ARM. What did you walk away with from SoftBank's release?
The thing I found really interesting, actually, were the comments from the CFO about their capacity, sort of implied capacity for more deal making, that their loan-to-value ratio is actually a lot lower than their targets. I think it's about 8%, and they target a maximum of 25%. That gives them a lot of headroom to be more adventurous and take bigger risks, and they seem to be suggesting that they are going to do that. Now, the focus of any deal making they have suggested is going to be in that semiconductor and AI space. We've heard reported that they, not least by Bloomberg, that they are seeking funding for a $100 billion chip venture to compete with NVIDIA. They've also, we understand, they're in talks to acquire GraphCore. That's a British startup developing chips in this AI space that seems to have missed a march when it comes to the competition. So there's lots they could be doing here, and it seems like they have the appetite to do it.
Okay, Alex, thank you very much. Great take there, Alex Webb, on the latest tech stories. Coming up, we are live at the Choose France Summit in Versailles with the CEO of Ontario Teachers Pension Plan, Joe Taylor. Looks after a few dollars. Context matters on Bloomberg. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
It's Bloomberg Brief. I'm Manus Cranny in New York. A very good morning. Well, the French President, Emmanuel Macron, is hosting his annual Choose France event today. That's in Versailles. The event aims to encourage international investment across France. My next guest is there. He is amongst the executives in attendance. Joe Taylor, CEO of Ontario Teachers Pension Plan, joins us for an exclusive conversation. Joe, thank you so much for being with us. You have probably one of the tougher jobs in the world, planning for the future, planning in part for other people's retirements. We debate inflation on a daily basis, but I want to understand what kind of a world you're preparing for. A higher steady state of inflation, a disinflationary world. What regime are you preparing for at OTPP? Good morning.
Well, good morning, and thank you for having me on the show. Well, let me start with inflation. It's very relevant to a plan like ours because we link all of our benefits to inflation. So the higher inflation, the more challenging our liabilities become. I think the other thing we would say is we're operating in a pretty uncertain world. I certainly subscribe to the theory that all of the things that have got us to where we are over the last 10, 15 years as an investment firm may not pan out as well in the next 5 to 10 years. And actually predicting what's happening in the macroeconomy as well as the geopolitical environment is really challenging. So what that brings you back to is actually trying to make good choices on a micro level around the companies that you're looking at and actually assessing whether they're really market leaders in their own domestic country as much as effective internationally. So when you come to France for Ontario Teachers, we have a number of companies here. They're all market leaders in their field. And France is an important market, which is why I'm here today.
And how much more? I mean, I look at the performance that you've had, and it's been tough. You've been underexposed to quoted equities. Real estate has been a tough time for you. But do you need a serious introspection on where you allocate capital to at the moment?
Well, we are the sort of plan where we try to compose a portfolio that is actually not necessarily going to shoot the lights out in really good times, but won't make a catastrophic loss in bad times. And I guess our outlook for 2023 was on the more conservative side, and that's why, back to your point, we missed out a little bit on some of the AI stocks, particularly in the S&P 500. But having said all of that, we have a portfolio which we think is actually quite well placed for what we expect to see through 2024 and 2025. The other thing that Ontario Teachers has is a very high allocation to private businesses, so whether that be in private equity, infrastructure, as well as sort of venture growth. And with those businesses, you really have to make the most of what you have, which is trying to make sure we add value to those businesses and help them grow beyond their local capability as much as possible.
And are we going to see you be a seller of assets in this private equity world? I mean, there's a blockage, isn't there? That's what everybody's telling Danny and I when they come on. It's tough to get assets to market. Are you going to be a seller, a driver of seller of assets this year in the private markets, or looking to do more deals and take more private assets on board?
Well, look, like many investors, we're always very keen to invest when we can get the right entry price. I think, honestly, there's a bit of a mismatch between owners of assets and their price aspirations just at the moment. From our perspective, in terms of the portfolio we own, I mean, clearly we'll sell assets if we get a good price for them, but generally we're a long-term investor. We invest our own capital, which also allows us to do that. And many of our companies are growing at good rates of return, so we'll actually hold those through the cycle to make sure they can deliver their full potential.
Well, let me be slightly more precise. I mean, we're talking about some of the assets that have built up quite nicely. I'm looking at Amica Senior, and there's a great deal of debate as to whether you really are on the point of pulling the gun on selling that. Are you? Is that the intention, and do you think that you can do that this year?
Well, Amica is a great business, and if we get the right price, we'd sell it as we would any asset. I think the issue for us is the future rate of growth you can continue to drive from that sort of business. So it's very well placed in terms of providing great care and retirement security for elderly entrants. But at the same time, there's a development issue in terms of the real estate portfolio in that business, where it's really down to can you get the right sites at the right prices. So, you know, I think we would be looking at it from the perspective of it's a great asset. It's grown very well under our ownership. We've owned it for a long time. You know, I think it, like anything, we're going to explore whether we continue to make that progress that we have in the last 4 or 5 years.
Now, look, you mentioned that perhaps not having had this sizable exposure to Mag 7 or big AI tech. I'm just curious in terms of the allocation to listed equities, public equities. Do you think that you're at a point of where you will materially scale up, add to those public equities, or are you still hesitant, Joe?
Well, I think the market's pretty fully priced in most countries. If I was picking out a segment we like, it's probably more like medical, which is actually a level below what we're seeing on the technology side, particularly AI stocks. But having said that, we can take equity risk by investing passively in markets as well as taking equity risk across other activities that we do, including private investing. So I don't think we have to do it just as a panacea for actually getting more equity risk into the portfolio. The other question we have is really one of, does it actually add to our liquidity options? So to me, the strongest reason to invest in listed companies at the moment is that you probably have an easier route to liquidity than you do in some of our private businesses.
I mean, I look at the other aspects that have been well reported, and it's to draw the differential rather than labor the point. I mean, you were a trailblazer in terms of property and real estate. I mean, that's down. It's been tougher for you relative to the benchmark. You brought that in-house, and I suppose the question that goes through our mind as journalists and as people that are looking at what you're doing is, are there going to be significant divestments and sales? Are you going to overhaul that property portfolio in any significant way?
Well, we brought the part of the real estate business in-house. We have our own Canadian real estate, Cadillac Fairview, has been hugely successful. But our in-house team is really to try and do two things. So one is invest in other countries, including France, where we have a joint venture with Boreal here. But also to invest in different sectors to what we own at the moment. So our real estate portfolio is quite heavily skewed to office and retail. And over here in Europe, we've been investing in life sciences as well as in industrial real estate opportunities, as well as we've been doing it in Latin America and other parts of the world. So I think that diversification by geography and by sector is really what we're trying to do with our own in-house team, but also to make sure we make similar choices to what we do in our other asset classes in terms of the rates of return and the accuracy of our prediction.
Just listening to what you're saying about, obviously, you're in France, I get that, and the investment narrative for you is about diversification within the property sector. Many people are debating U.S. exceptionalism. It's been a reason to be overweight the U.S., overweight property, overweight equity, etc. Do you think we are hitting some kind of a period, perhaps, where global markets may well challenge that exceptionalism of the U.S.?
I think it's always very dangerous to bet against the US. It's been a very strong market for us and for most investors for 20 years. But if you come back to France, it's currently our 5th largest territory by investment. We've got about 7 billion euros of assets here. We've got some great companies that are market leader in what they do in France. And in terms of your question, in terms of other territories to the US, I mean, Europe's been pretty steadily for us somewhere between 50 and 20% of our portfolio. It has, I think, solid growth rates with large companies with experienced management teams. Certainly on the private side, I'd expect it to remain a core part of our portfolio holding.
Joe, enjoy Versailles. Apparently the weather's a little bit better there than it is here in cold and wet New York. So good luck with that, and we look forward to hearing from a number of voices from Versailles later on today. Joe Taylor of the Ontario Teachers Pension Plan. And as I say, we've got a good lineup for you coming from Choose France Summit in Versailles. 10:30 a.m., an exclusive interview with the Goldman Sachs CEO David Solomon, followed by our editor-in-chief. It is John Micklethwaite sitting down for an exclusive conversation with the French President Emmanuel Macron. You can watch that at 1 p.m. Eastern. Context Matters on Bloomberg.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Bloomberg Brief. I'm Manus Cranny in New York. Here's a look at what's ahead this week. Today, an exclusive interview with the French President Emmanuel Macron at 1 p.m. Eastern. And the Qatar Economic Forum, powered by Bloomberg, starts on Tuesday. Then we have the April CPI report and the retail sales kick in on Wednesday. Later today, Archegos founder Bill Huang returns to New York to the courtroom. Opening statements will begin in the criminal trial over the epic 2021 collapse of his family office. Bloomberg's Shonali Bassick joins me now on what we can expect. Quite a bruising number if you just think back. Credit Suisse, Nomura, and Morgan Stanley on the hook for $10 billion. That's really what this debate is about, responsibility for these losses.
Responsibility for those losses, and remember, part of the issue here was also the allegations around him conflating the stock prices around very household name stocks like Viacom, CBS as well. So the allegations here revolve around racketeering, conspiracy charges, as well as securities fraud and wire fraud offenses, not only against Bill Hwang, but also his former chief financial officer, as well as his former trader and former risk management, both of whom already pled guilty and will be cooperating witnesses in this trial. So today we'll see the opening arguments from both sides. And of course, this will start a multi-week trial that is being really closely watched, not only by the banks themselves that had lost, to your point, billions of dollars, but also by a lot of the investment community here, where, you know, a lot of this, Manus, had happened in the shield of a family office overview here, where the disclosure rules are not the same as a traditional way hedge fund.
Yeah, and therein lies the leverage aspect to it, and in terms of the internal organizations, were they monitoring, were they, you know, did they have the truth on one side, and were they monitoring robustly on the other? Talk to me, you mentioned there that there's two of his colleagues, former top Waukegan associates. They've already pleaded guilty, and they're going to stand trial against him?
Exactly.
What do we know about them? Who are they? Talk to me.
So we're talking about Scott Becker and William Tomita, who are here, former, as we said, top executives at Archegos, who are expected to not only testify, but we expect prosecution to also bring forward more than 24 counterparties here, executives from different banks as well. So that's what we can expect out of the defense. When we think about the former Archegos officials as well, one big question is how they might invoke the past. Bill Hwang's history when it came to Tiger Asia, which had also previously faced charges of its own as far as insider trading goes. Remember, Bill Hwang in that instance didn't admit or deny wrongdoing, but had faced a significant settlement. So how much will they bring in the history, as well as really blame the management at Archegos versus what the defense might try to do, which is really talk about the bank's own lapses.
Yeah.
And as we know, Credit Suisse itself had a large report as far as its own risk management controls, and there are questions about how much of that might be brought up and whether the judge will allow cross-examination here to a significant degree. We know the defense does not want that to be significant here.
Shanali, thank you so much. Shanali Basak will be tracking the court case against Bill Hwang right here on Bloomberg. Micro movers for you. Alphabet drops. This is as the Google search may be hurt if Apple closes in on the deal with OpenAI and uses ChatGPT. You got GameStop up nearly 20% as its monthly gains mimic the meme stock mania of 2021. Microsoft plans to spend $4.3 billion on building cloud and AI infrastructure in France, and of course that is the main event of the day. Part of Emmanuel Macron's Choose France, which aims to attract foreign companies to France and make it a financial hub for the European destination. And of course, we will have the Macron interview a little bit later on today. Here's a state of play on some of the commodities. Of course, as China steps in with $138 billion worth of stimulus and long bonds, it manifests in the commodity complex going bid.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
The Fed will likely move once, maybe twice this year, and obviously that has to be later in the year.
I think they go at least once. I think 2 is a good baseline, and I think there's an option for 3 if we're right about how quickly inflation slows.
They're still very much focused on eventual policy easing.
They'll move if the data warrants it, meaning that there needs to be a shock in much weaker data.
I think they'll take out some insurance cuts, which will elongate the recovery that we're in, and that will ultimately set up this bull market to last for years to come.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Heading into a week of important inflation data, and 2 of us are live in D.C. One of us is in Paris, and Surveillance family member Danny Berger and co-host for the show is in New York. Welcome to Bloomberg Surveillance. More on why we're all over the place to start the week in just a second. When you want to set up a really important week, though, that really kicks off in some ways on Wednesday with a pair of data releases that may solidify a narrative that's been flipping and flopping. Danny, I want to get your take on why Wednesday is going to be so important.
Why Wednesday is going to be so important, Lisa, is because this market has decided with the weak data coming from the consumer, whether it be sentiment, whether it be the earnings, the weak data coming from jobs moving in the wrong direction, if inflation doesn't also soften, maybe we'll start talking about the S word, stagflation.
I mean, indeed, that's part of the fear right now. In the meantime, we are in Washington, D.C. Let's get to the why. Anne-Marie, you have a really important interview with Janet Yellen, Treasury Secretary, coming up later this morning at a time when industrialization and the Chinese-U.S. relationship, frankly, is what every CEO, every consumer, and frankly, every politician is focused on. What's going to be your focus this morning?
That's right. We're sitting down today, and actually, she's going to be in Virginia talking about some of this money that's been flying out the door in Washington when it comes to whether it's the Inflation Reduction Act, the American Rescue Act, CHIPS. She's going to be talking about broadband, bringing it to rural Americans. At the same time, we look ahead to tomorrow in Washington, D.C. The president's going to announce tariffs going up, the walls going up when it comes to those imports from Chinese goods, whether it's batteries, EVs, solar, coming into the United States. But we have to remember, and Terry Haynes will be on us a little bit later, I think he's going to want to make this point, a lot of this is symbolic because some of these materials are not even in the United States right now.
And it also raises this question about what it will do for inflation, what it will do to the economic trajectory, given the fact that a lot of people thought that this would be something that could put a damper on certain activity. Inflation, I know you're focused on electric vehicle policy and all these other things that very much have people's attention, but inflation very much in the forefront of people's minds here as well.
Look at the consumer sentiment we got on Friday. It was a huge push lower, and when you look at what individuals in America are thinking about where inflation is going to be longer out term, in their mind, they're starting to think it's going to be higher. This is a psychological effect. And even though you have the Biden administration talking about Inflation Reduction Act, American Rescue money, going out the door. They want to build up the capacity in the United States. They're talking about how they're going to talk tough on China with tariffs. At the same time, poll after poll continues to show it's inflation that Americans are most concerned about.
I love it. Basically, what we have is AMH talking to Janet Yellen today. The reason why Jonathan Ferro is not here, he's in Paris. He is going to be speaking with David Sullivan of Goldman Sachs. Very much looking forward to that. I'm here to worry about the deficit with other people who are focused on the Treasury auction. Coming up, Janet Yellen, don't miss that. Emmanuel Macron, don't miss that, with John Micklethwaite, our executive in charge in Bloomberg News. And David Solomon with Jonathan Ferro coming up later this morning as well from Paris. And a real question here about how some of these executives really do deal with some of the crosswinds that we've seen only get more significantly fraught, really. What we're seeing in markets is the longest streak of gains on the S&P going back to early February. Right now, we're starting to kind of continue it, trying to start an upbeat up to about 0.1% on the S&P, 52.51 at a time that some people were saying this is the beginning of a correction. What you're seeing is a little bit of dollar strength, but it's been all over the place with a bit of yen strength overnight, given the fact that Japanese authorities actually didn't buy back as many bonds as many people had been expecting. More of a downward trajectory for 10-year yields, only lower by about 13, 14 basis points from where they were at the end or the middle of April. Sort of an interesting trajectory given how much people have pushed back rate hiking expectations. And then what we have is crude just a little higher, but it had been lower last week. Coming up this week, we were talking about this, a really important week ahead, given the fact that we are going to be looking at what happens on Wednesday with a pair of data releases. We get retail sales as well as consumer CPI, which together will give you a sense of whether this is stagflation, whether this is Goldilocks, or whether this is a no landing. It is a flipping and flopping narrative. What we have today is we have some New York Fed data coming out about forward-looking inflation expectations, as well as the Fed's Messer and Jefferson. Tomorrow we get PPI. Fed Chair Powell is going to be speaking, as well as Lisa Cook. We're also going to be getting Home Depot earnings. And then on Thursday, we do get Walmart earnings, which will be key to watch, as well as a host of Fed speak. Coming up this hour, we have Cameron Dawson of New Edge Wealth, and U.S. growth and the consumer are very much in focus this week. Terry Haynes of Pangea Policy as the Biden administration ramps up pressure on Israel, and John Riding of Green Capital on the Fed's outlook with PPI and CPI on deck. Let's begin with our top story. The S&P 500 looking to build on 3 weeks of gains as investors prepare for a busy week of data. Cameron Dawson of New Edge saying this market continues to be all about growth. As long as GDP and earnings growth aren't being revised lower, the equity market has been able to shake off a tighter Fed and higher rates. Maybe until now. Cameron joins us now. Cameron, I'd love to get your take, and wonderful to see you, on how important Wednesday is going to be to really understand whether we're in a no landing, whether we're in Goldilocks, or whether we're headed toward the dreaded stagflation.
To judge that, I think the retail sales will be the most in focus, meaning that are we still in a world where this market is able to shake off bad news and consider it good news because the Fed can bail you out? The thing that we've seen, though, is that economic surprises have really plunged over the last couple of weeks and are now in negative territory, the most negative that they've been since 2022. And of course, back in 2022, we were cutting estimates for GDP rather rapidly, which was leading to this weak sell-off within equity markets, within credit in 22. So can we still be in a world where economic surprises are weak and equity markets shrug off and move higher? We're not so sure, which is why we continue to watch those GDP estimates and earnings growth estimates so closely.
This raises this question about how close we are to the stag, to something where we could see inflation expectations stay higher, where we could see yields remain sticky, Fed expectations pushed out as they have been to maybe September, but really some more bad news getting priced into equity markets that are looking for reasons to rebound.
Well, if you're looking for the stag, really start with PMIs. That's where we saw in both services and manufacturing. You saw new orders turn down, employment turn down, the overall outlook turned down, and yet prices jumped up rather materially. And if that is a picture of the rest of the economy, then that's when you could start to see this sticky inflation, but you're not getting the growth to offset it. Now, the thing with equities I think is important to remember is that equities still do like inflation, meaning that it gives them pricing power. So of all the asset classes that can tolerate that environment, it would be broad equities. However, it then raises the question, what does the Fed do in that scenario if you have that sticky inflation, but growth really isn't holding up?
You say that you're excited about retail sales, Cameron, but how concerned are you about the consumer sentiment data we got last week, the lowest we've seen in 6 months?
Yeah, consumer sentiment has been one of those where it's watch what they do, not what they say, meaning that consumers have been able to spend even though they've been reporting very sour outlook about what they're thinking about the economy and their forward outlook for incomes and overall financial situations. But are we at the point where consumer sentiment is picking up on moderating real wage growth? That's really important because we have seen wages moderate, yet inflation is staying sticky. So where real wage growth has been recovering for much of the past year, it's starting to stagnate. And we think that's one of the reasons why consumer sentiment turned so much lower last month, is that consumers are feeling the pinch from inflation. They're starting to lose purchasing power again, and they're feeling pretty sour about it.
So what kind of equities do you want to be exposed to if that's the environment we're preparing for?
Yeah, we still really like large cap, high quality equities because you get the combination of a few things. You get good balance sheets, which means that they're able to deal with higher for longer better. In the smaller cap areas of the world, you have balance sheets that have more floating rate debt and a big refinancing cycle, which just means that the balance sheet can get pinched if the Fed isn't cutting interest rates. But in the large cap quality part of the world, you also have pricing power and good return on invested capital. So what we look at is that across sectors, we're looking for those highest quality names at the top of each sector that have the ability to navigate this environment, even if it means a more challenging one than the one that we've been in over the last year.
Cameron, I feel like we're setting up the week really well in the sense that we're very much focused on what happens Wednesday with the economic data. We are in Washington, D.C. Danny's in New York. What we're dealing with John over in Paris is global CEOs trying to basically act as the ambassadors for the United States at a time of really uncertain foreign policy. How much are you watching some of the tariffs that are coming out, some of the policies that really are hewing more to the industrialization side in the U.S. to really make investment theses?
Yeah, I think we have to see the counter of it, which is that on the one hand, we have tariffs, which can certainly disrupt supply chains, but we also have huge fiscal spending. You mentioned the rural broadband, things where we're starting to see a lot of spending that is flowing down to a lot of industrial names. Now, the real peculiar thing is, to bring it back to PMIs, is that we've seen a huge surge in manufacturing, construction, and all of this fiscal spending, but it's not showing up in PMIs and broadly being enjoyed by the broad manufacturing sector. So in that sense, what we think is that you continue to have this push-pull between tariffs as well as fiscal spending, which just creates uncertainty and disruption, but good companies should be able to navigate that.
Which raises this question on the other side, and I haven't explained why I'm here. I'm actually here to worry about the deficit. I'm here because basically you have a lot of people who are getting together from the Congressional Budget Office, from Wall Street, to wonder how much we have to care about an unprecedented debt load in this country and when it's going to actually start to bite on interest rates. Do you worry about that? We heard last week from Steve Eisman that, the deficit people are just wrong, and they have been for the past 30 years. Are you among the the deficit people who are watching for this to actually trickle into some of the pricing in the next couple of months?
It's certainly one of those things that it's not a problem until it is. And we would look to the bond market and the long end of the bond market to price in some of that stress or uncertainty, because of course we saw that in a very short window last year when Treasury really increased coupon issuance, and we saw Treasury yields in the 10-year sell off really rapidly. When we think about going into the election, the biggest takeaway that we have is that neither party is talking about austerity, which means this is so very different than times of high deficits like coming out of the great financial crisis, where, of course, in 2010, you had the Tea Party and you had the Budget Control Act, which really was an effectuation of a lot of austerity pushed by voters. So it doesn't seem to be a priority for voters, which is why we don't think that we're going to hear much from either party, which means get used to higher coupon issuance, get used to higher deficits, because it doesn't seem like either party wants to push austerity.
We're going to be talking about that throughout the day, throughout the year, so you've got more to look forward to. Cameron Dawson of New Edge Wealth, thank you so much for being with us to kick off this week. And that's what we heard certainly over the weekend from Donald Trump in terms of not really exactly an austerity push, Anne-Marie.
No, it's not going to be an austerity push, regardless of who's in power. I think this is what people are starting to realize. Next year, this is what David Malpass last week told me about, this perfect storm. You have another debt ceiling fight. You have the perennial fiscal spending fights in Washington, D.C., but also the
tax-era Trump cuts, they're going to expire. What does that mean for the deficit? Probably what we're going to get is more tax cuts that are announced, at least based on some of the rhetoric that we heard overnight. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Hakez. Yahira.
Hi, Lisa. Amazon, Pfizer, Microsoft, and Morgan Stanley are among the companies poised to boost their presence in France. President Emmanuel Macron will host 180 CEOs and executives for the Choose France Summit. The flagship event, now in its 7th year, is part of a push by Macron's government to attract foreign companies and make it a financial hub for the post-Brexit European Union. Donald Trump pledged to double down on tax cuts if he wins a second term as president. Speaking at a rally in New Jersey this weekend, Trump said, quote, "Instead of a Biden tax hike, I'll give you a Trump middle class, upper class, lower class, business class, big tax cut." President Biden has called for tax hikes on businesses and the richest Americans. And campus protests over the war in Gaza are colliding with college graduation season. Comedian Jerry Seinfeld was the commencement speaker this weekend at Duke University, where about 30 students walked out chanting Free Palestine and waving flags when he was introduced. But Seinfeld didn't address the protests. A small group of demonstrators also showed up at UC Berkeley's commencement on Saturday, but the university says the protesters left voluntarily and no one was arrested. More schools have threatened student protesters with arrest or expulsion if they don't clear out pro-Palestinian encampments ahead of graduation ceremonies. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, Blinken issuing a strong warning to Israel.
Israel's on the trajectory potentially to inherit an insurgency with many armed Hamas left, or if it leaves, a vacuum filled by chaos, filled by anarchy, and probably refilled by Hamas.
That conversation coming up next. You're watching Bloomberg Surveillance.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Earnings season is here.
This is a get out the popcorn moment.
Across the board, just pummeling of expectations.
Earnings matter. That's really clear.
Bloomberg is first to break the numbers.
Hey, folks, we've got Microsoft.
Apple earnings crossing the wire. Alphabet, wow, coming in way above expectations.
Hertz driving in the opposite direction.
A lot still to come.
With the smartest insights.
Meta's kind of damned if they do and damned if they don't.
Is this their iPhone moment? I view this as Operation Kick the Can to August.
Continuing coverage on Bloomberg. Context changes everything.
Under surveillance this morning, Tony Blinken over the weekend going the rounds on a number of different shows, issuing a strong warning to Israel.
Israel's on the trajectory potentially to inherit an insurgency with many armed Hamas left, or if it leaves, a vacuum filled by chaos, filled by anarchy, and probably refilled by Hamas. We've been talking to them about a much better way of getting an enduring result, enduring security, both in Gaza itself and much more broadly in the region.
Here's the latest. U.S. concerns growing as Israel increases its Gaza offensive. U.S. Secretary of State Antony Blinken warning of a post-war Gaza still armed with Hamas militants, risking insurgency. Blinken adding that Israel has not presented plans for the enclave's future. Terry Haynes of Pangea Policy joining us now for more. And we did see Tony Blinken, good morning to you, really making the rounds throughout the weekend, talking about how there is a question of whether there have been some humanitarian violations, but they continue to have full support for Israel. Was there anything conflicted, in your view, about the message from the Biden administration?
The message of the Biden administration is nothing but conflicted, I think. Secretary Blinken, no disrespect, what he had to say in your bumper, he could have said and probably did say 6 months ago. They also certainly need an exit plan. The United States, among other things, is being very coy about, what the better way is. But beyond that, every participant in the region will want to know two things. Firstly, what is that plan? There are three things. Secondly, is it feasible? Thirdly, will the United States stick to it? 20 years ago, President George W. Bush issued a bunch of guarantees in that region that were systematically stripped away by the Obama administration and not followed up on by the Biden administration. I'm not saying that to make a partisan point. I'm saying that to say the United States needs to get in there, stick in there, and in order to become a full partner, needs to move things forward, not just with Israel, but with the region as well.
How much of this is because of growing domestic pressure on the Biden administration?
Oh, some of it, certainly. I'm not going to, Lisa knows I love percentages, but I'm not going to assess one on this one. But I'd be foolish to say there's no politics involved in a decision that has a political dimension. But at the same time, what you have is a situation where, there's too many cooks in the kitchen, I think. The president looks muddled, and at a time when what the United States needs both domestically and for foreign policy is clarity.
We're moving closer to the election, less than 6 months now. Domestic pressure when it comes to the youth vote, when it comes to what's happening in Gaza. But also tomorrow, the president is set to unveil these sweeping tariff hikes on a number of, whether it's EVs, solar, batteries coming in from China. You say all of this is noise. Why?
Well, I say it's noise for a couple of reasons. One is that, tariffs already exist, so cranking out tariffs is not exactly, the biggest news in the world, although the markets will take it as a negative signal. Secondly, what I think is what markets may miss is that you have a situation where it's not just about tariff policy. It's not just about chips. It's not just about, a few things that the administration and Congress are doing to try to meet Chinese competition. What we're sliding into here now is a situation where either administration, either a Biden administration or a Trump administration, will deal much more forthrightly to shore up the defense industrial base going forward. And I think that's a signal that you get out of the tariffs decision, but one that markets may miss.
Well, this raises this question of how much more capacity the United States to do this, given the fact that some people worried about the deficit. And we do have this concern about the increasing sizes of auctions. Is there a sense that there is the capacity in the budget to really increase spending on defense, increase spending on CHIPS Act and things of that nature?
Well, the politics in Washington aren't coherent on this. I mean, you've got two political parties, one that basically denies the deficit's a problem, the other one which wants to pretend they're dealing with a deficit problem by cutting 1% out of the 30% of discretionary spending. So neither party is particularly serious on this. So what you're going to get, as your previous guest Cameron talked about, and what you all talk about a lot, is that you're going to get deficits into the far future, and neither Biden nor Trump is going to be able to fix this unless you get a situation where there's an all-red Republican sweep in Washington, which I think is at best about a 30% possibility. It's not my base case, which is Biden and a split Congress. What you get is a situation that's pretty much like the status quo. People won't care about deficits, but they'll throw as much incentive as they possibly can at building the defense industrial base even more.
This is going to be pivotal next year because there's the debt ceiling fight, but there's also the potential extension of the Trump-era tax cuts. Trump basically says he's extending all of them across all board. He said that over the weekend. The Biden administration is interested in extending them for some, but they want to raise the corporate tax rate.
Right.
Do you have a base case of what potentially will get through Congress in terms of the extension of those tax cuts?
The base case will be a lot closer to the Biden case than it will be to the Trump case, because unless you have, everybody remembers in 2016 that Trump's election was greeted with euphoria, which was not exactly a base case with a lot of analysts, right? But it wasn't Trump. It was Trump plus an all-Republican Congress, because they knew the path to the 2017 tax bill would be a lot smoother. That's not going to happen this time. As I say, that is not the base case. Base case, I think, is Biden still squeaks through. Even if Trump wins, you're probably going to end up with a split Congress. So, those speed bumps, to do something like Trump wants about the 2017 tax law won't exist, frankly. Democrats will dig in.
Well, what kind of corporate tax rate do you think we could see? Because I'm pretty shocked that some Republicans are saying, actually, we don't want to lower it to 21%. We think it should be higher.
Yeah. My gut is, and it's instinct only, is that you look at something like 23, 24, 25%.
The Joe Manchin route?
Yeah, kind of. The soundings I get is that, corporate's not only a relatively small part of this, but that corporate believes they can deal with a small uptick in corporate rates. And it's the personal rates that are the big problem and that are the big deal. And, when I was doing this in a previous life, the question I asked our economist essentially was, how low can you get the personal tax rates? Increase the deficit by how much? And it was basically, you can get them to 20% if you increase the deficit 1.5 trillion over 10, which sounds like a lot, but it's not, right, in Washington terms. And then, so that became the bogey like a year out, and that actually happened. So, I would look at a small uptick in corporate, but at the same time, I would look at in a Democrat split Washington, I would look for more taxes on the wealthy.
Just in this whack-a-mole Washington that we've been playing this morning, what's the number one question that your clients are asking you heading into the election?
It's really what the effect on the economy is going to be, very simply. Like, what do you think? A lot of the things we've just talked about.
And basically, you look at them with a blank face because it is very unclear what effect it's going to have on the economy other than bigger deficits.
It'll have a mitigating impact, but will it be large? I don't know. But the move towards a more defense industrial-based incentive from Washington, I think, will cause more roiling than is now anticipated.
Terry Haynes, wonderful to see you. Terry Haynes of Pangea Policy joining us here in Washington, D.C. Always wonderful to hear from you. Coming up, Bloomberg's Michael Shepard on the race to fund chip production and higher tariffs aimed at China. All of that coming up. And, of course, do not miss our conversation with our own Anne-Marie Hordern with Janet Yellen coming up later. It's going to be a great interview.
We're going to be talking about some of those themes Terry just mentioned.
Yeah, and get her sense on exactly what the threshold will be for them to amp up some of the rhetoric and action. From Washington, D.C., from New York, from Paris, this is Bloomberg Surveillance.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
This is Bloomberg Surveillance heading into a fourth week, potentially of gains, at least based on where we are. We are in Washington, D.C. I'm alongside Anne-Marie Herdern. I'm Lisa Abramowitz. John Farrow will not be with us today or tomorrow because he will be interviewing David Solomon of Goldman Sachs. Later this morning, Anne-Marie Herdern is going to be speaking with Janet Yellen. Right now, what you can see in markets is trying to rally yet again after 3 straight weeks of gains. You can see that gain really starting to increase just a bit more, 52.53 on the S&P, up 0.1%. NASDAQ futures up more than 7% since the end of April 19th that week. We could see that continuing, 0.2% gain there. What you could see in the bond market, and this to me has been one of the most interesting plays that we've seen, given the fact that people are pushing back expectations for a Fed rate cut to potentially September, yet really got a dose of cold water poured on some of the optimism of some of this Goldilocks type of environment. Last week, Anne-Marie, we saw this fact that potentially inflation expectations creeping higher, even as people's sentiment coming down, raising the prospect of stagflation or yields that can stay a bit higher for longer, even with some of the deteriorating sentiment.
This is what David Malpass, former head of the World Bank, was talking about yesterday. He joined us here in Washington, D.C. Very different vision of how, say, the Treasury Secretary Janet Yellen and the White House view where this economy is going. But then Friday, you get this consumer sentiment report, the lowest we've seen in November, and how people are starting to view inflation as a bigger problem. Remember, prior some of these consumer surveys, people are starting to worry about the labor market. But again, it's inflation once again that's top of mind.
Which raises this question for the dollar. We saw that streak of dollar strength, and a lot of this was predicated on the idea that the U.S. was going to be cutting rates last and way after a lot of the other central banks. A question now of whether that's true and what other central banks are doing to mitigate it, which you could see right now is a little bit of dollar strength. The euro, you could see losing just a little bit. But what's more interesting is what's happening over in Japan, given the fact that we saw the Bank of Japan decline to buy as many bonds as people previously expected. Yields at the longer end of the yield curve in that country rising to the highest going back to 2011. A question on what other central banks can do to offset, and not just central banks, but fiscal authorities can do to offset this idea that the U.S. has been in an exceptional place.
The U.S. is exceptional, although Peter Cheer, and I know he's going to be talking to you later.
Actually exceptional.
Yeah, he's questioning it. But when you talk about the yen, it's the weakest out of all G10 versus all G10, the yen's the weakest, and they continuously try to prop it up, and it's not working. So until they look at monetary policy, it's a great question. What can they do? It's very difficult to fight U.S. exceptionalism at the moment.
Unless it's not really exceptional enough, and we will talk to Peter Scheer about just some of the potential cracks under the surface. Under surveillance this morning, traders preparing for a busy week of data, PPI on Tuesday, CPI and retail sales, the trifecta on Wednesday, jobless claims on Thursday, plus another look at the consumer with the earnings from the Home Depot and Walmart. More interested actually in Walmart even than Home Depot, since it's potentially a read on how much people are downshifting. But Anne-Marie, very much, to me, the idea that we get the 1-2 punch on Wednesday of both CPI, Consumer Price Index, does it come in hotter than expected, which really sort of threatens this Goldilocks type of disinflationary narrative? And do we see retail sales come in significantly, given the fact that's just getting more expensive and harder for consumers.
CPI on Wednesday, our survey is showing 0.4% increase. Is that what the market is expecting? If it is hotter, how much more challenging is that going to be the Fed? And does that change the narrative on these cuts? Does potentially 2-1 baked in now become maybe 0? And how does that happen even potentially before the U.S. election? But to your point, retail sales and what is Walmart, Home Depot, what are they telling you? I go back to what Mohamed El-Arian said. What everyone missed in that transitory view of 2021 was they were listening to CEOs in the earnings calls saying that inflation is still in our pipeline and we're still struggling with this.
But some companies still raising prices, which is a reason why people are concerned about what this means. Very curious to see also about the reaction function from the Federal Reserve when we get a host of Fed speak this week, potentially about how they're going to deal with the fact that growth might be slowing and inflation is not really coming down as quickly as people would like. Meanwhile, and this is something that, Emery, I know you have a lot of insight on, Russia's President Vladimir Putin, with a surprise shakeup in leadership. Putin appointing First Deputy Prime Minister Andrei Belousov to replace Defense Minister Sergei Shoigu. Shoigu will take over as Secretary of Russia's Security Council as Putin looks to grow the country's war machine against Ukraine. Really interesting since Shoigu is such a stalwart supporter of what we saw in Ukraine, given the incursion, replacing him with an economist. How do you understand this?
So this has to really go down to the idea that Putin probably is thinking that this is going to be a long, protracted war, and they want to make sure they are shoring up the economics of being able to fight that war. And there's been some frustration from the Kremlin with Shoigu, but they are moving him to a top position. Now he's going to become the head of their National Security Council. This is the post Nikolai Patrushev has been holding. I think what was more stunning yesterday was the fact that Patrushev has been dismissed from this job. We still don't know yet, though, where he's going. So Peskov came out and he said that he will go somewhere, and they'll announce that in the next few days. But this is a long-time Putin ally, and it's just interesting to see that they're pushing him to another position. We don't know yet. So we're not sure whether it's a proper, potentially, if he's being really ostracized from the small circle Putin keeps around him, or potentially it's going to be something even closer.
I also wonder, though, if there's a signal here, and that's, I guess, what a lot of people are wondering is how much can we understand maybe more of a focus on the economic damage of the incursion in Ukraine, or is this just, an indictment of some of the failures on the battlefield that we heard from the Wagner Group and we heard from some others? Do we have a sense of that, or that's some of what people are going to be parsing through?
I think that's part of it. There has been issues on the defense front. I mean, you saw what happened with Yevgeny Prigozhin and how he took on Shoigu. There have been issues within the Russian military apparatus, but at the same time, this is classic Putin. He loves keeping everyone on edge, and he does from time to time like a big shakeup.
And that seems to be what we got overnight. Meanwhile, Bloomberg reporting that the U.S. and the European Union have spent $81 billion toward the next generation of semiconductors. This is the first wave in an expected $380 billion set aside globally for the industry. And this week, the White House is expected to unveil increased tariffs on key industries between the U.S. and China, including Chinese electric vehicles. Bloomberg's Michael Shepard joining us now. Shep, we've been talking all morning about the electric vehicle tariffs. I know that Emery is going to get into that with Janet Yellen later this morning, among other topics. We haven't talked about what Terry was talking about, which is the increased spending on defense and industrialization, the defense military complex. How much is increased chip spending almost a part of that?
Well, chips are essential to everything all around us, but especially in the military area these days. From the legacy chips that go to power some of the more sophisticated weapons that are being deployed on the battlefield, to some of the more advanced technologies, such as AI, that the military is hoping to deploy. And all of that is really sensitive, and it is part of the defense intelligence and technology base that the Biden administration is trying to build up, also in tandem with the Chips and Science Act.
This reverses a long time where outsourcing really was welcome in terms of getting things cheaper. And we've seen this shift going back a number of years where we've really removed some of this technology from China. How much can we measure any efficiency? Can we measure any potential added benefits from every country going it alone? Or does it feel like potentially a lot of waste and thrown money at something that worked a lot more efficiently before?
That's a great question, Lisa, because you're really getting to the heart of what comes from all this spending. What is going to be the fruit of all this investment from governments globally? And we are not going to know for a decade or perhaps longer than that. It takes so long to build one of those chips plants get it under production, and then you have to see what the market actually bears. Right now, the trend with the push in AI and all these other advanced technologies like quantum computing indicates that we need many more chips than we can make right now. And then also on the security front, we were just talking about Russia, but the China question does loom over investments in chips as well. What will happen with Taiwan? The Pentagon has indicated that China would be ready to undertake an invasion of the island as soon as 2027. So that is overshadowing the U.S. thinking on its preparedness. Right now, the United States doesn't make any advanced chips in this country domestically. The goal of the administration, Gina Raimondo has said herself, by the end of the decade, they want 20% of the production of those most advanced logic chips. And that will be a big leap. And it will depend on the ability of companies like Intel and even TSMC through facilities that are being built now in the U.S. through this CHIPS and Science Act money to deliver that capacity.
Is the Chip and Science Act in jeopardy if Trump wins?
That's a great question, Anne-Marie, and one of the things that we'll have to watch is how it gets implemented. While the money has been promised to a lot of these companies, about 85% of the grants have already been at least parceled out on paper to companies like Intel and Micron Technologies. But one thing we haven't seen are the actual checks. You see, the companies have to go through this phase of due diligence. They have to meet a whole series of milestones and promises to get the next round of actual funding in their bank account. So it will take some time. And then whether the administration, if it is a Trump presidency, continues with the same vigor in that direction, it's a great question.
Let's talk about what we do know, which is tomorrow, Biden's going to be hiking tariffs or keeping some tariffs the same on a number of key sectors of these goods coming from China. I have some reporting about what that means for EVs. Now it's going up to a 102.5%, even though there's not a single EV right now, a Chinese EV in the United States. What is noise and what is real that comes out tomorrow?
Well, I think it's both noise and real. And the noise part is the impact in the moment. Because as you say, Anne-Marie, right now, exactly, it's symbolic. We don't see any Chinese EVs driving around on the streets. You can't go to a BYD dealership to pick up your Chinese-made or Chinese-branded electric vehicle. But the administration is trying to stave off future imports of these Chinese products because the government in Beijing is really making a big push to invest in this industry, and the administration here is concerned that that will lead to a flood of imports here and disadvantage American makers. And then there is also the data security question, too, that they keep bringing up. The EVs gather up so much information, and they're concerned about where that goes.
Yeah, the heavy lifting that national security has done. We talked about that extensively. Can you explain to me, we're talking about tariffs, we're talking about increasing the barriers for electric vehicles coming into the U.S. from China, and then on Friday, Zeekr Intelligent Technology IPO'd. This is a unit of the Geely automotive company over in China. Electric vehicles, a higher-end version of them, coming to the United States. And basically, people loved it. People couldn't get enough of it. It popped 35% in the first day of trading. What gives?
Well, people were drawn to the technology, and it was interesting during the interview. The executive seemed unfazed by the prospect of these tariffs.
Short-term noise.
Short-term noise, or maybe looking at markets elsewhere, outside the U.S., where that his products may actually gain a foothold and leave the U.S. market out.
Which raises this question again about Paris, and John Farrow, who's off in Paris and is going to be speaking with David Solomon as all of the executives try to lobby in different places right after that travel from Xi Jinping over to the region. Bloomberg's Michael Shepard, thank you so much for being with us. Always wonderful to see you. Let's get an update right now on stories elsewhere this morning. Here is your Bloomberg brief with Yahaira Hakez. Yahaira.
Hi, Lisa. Sticking to China, U.S. officials intend to highlight security concerns with China's development of artificial intelligence when they meet tomorrow in Geneva. The meeting will jumpstart talks agreed to last year by President Biden and Xi Jinping to address security and safety concerns over AI, even as the two countries intensify their competition in that space. Xiaomi is pushing ahead with plans to make an SUV similar to Tesla's Model Y. It comes as the company is approaching full capacity and is working on increasing output to satisfy demand as it looks to compete in China's crowded EV market. The company plans to begin making and selling the new model as early as next year. Disney's Kingdom of the Planet of the Apes took in $56.5 million to top the domestic box office this weekend. That was more than the up to $50 million projected. This marks Disney's first release of a new film in theaters this year. Other big-budget Disney pictures due out this year include Pixar's Inside Out 2, Marvel's Deadpool and Wolverine, and Moana 2. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Heated debate here about wasn't Planet of the Apes made in like 1962? What year?
1963.
Oh, sorry. Totally off. This is the issue. Is this sort of the new playbook is just make movies that were made previously, make them again?
As Yahira's talking about it, I'm like, they made a new one? Isn't that old? What's old is new again?
Oh, yeah. And then we can get Steve Eisman on to comment on just what the review is and who they killed off. Anne-Marie now is heading off for a really important interview with U.S. Treasury Secretary Janet Yellen. Do not miss that. I am so excited to hear about it. Were you guys going to be in a field or something?
We are going to be in rural Virginia, where she's going to be talking about the expansion of broadband to rural areas. That's her big pitch today. And actually, I got a fact sheet from the White House today. The entire week is going to be filled with White House aides or cabinet secretaries going out for ribbon cuttings. All that money and that legislative agenda, they want to see it being put to work.
It sounds like it is Infrastructure Week here in Washington, D.C.
It is.
And it has been for a while. Up next, the stubborn last mile for inflation.
The Fed and investors alike are looking for meaningful reprieve in inflation, but unfortunately, I think they're going to have to continue to wait for some time longer.
That's coming up next. You're watching Bloomberg Surveillance.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep rain while covering. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome back. This is Bloomberg Surveillance. Under surveillance this morning, the stubborn last mile for inflation.
The Fed and investors alike are looking for meaningful reprieve in inflation, but unfortunately, I think they're going to have to continue to wait for some time longer. My base case is that inflation remains stubbornly elevated, well above the Fed's 2% target through the end of the year, keeping the Fed then potentially on hold through the entirety of 2024.
Here's the latest. Investors looking ahead to a full slate of economic data this week, including CPI, that key one on Wednesday. John Writing of Breen Capital writing this. As inflation approaches 2%, the Fed should dial back restraint, but 2 cuts into September and December would probably just keep policy at an unchanged degree of restraint in 2024. There is the recession scenario, and then cuts would be more rapid. But this is probably a 2025 story if it happens. Let's head up to our New York studio where Danny Berger has been patiently waiting and listening and is joined by our very own John Writing is joining our very own Danny Berger. Danny.
I was going to say, Lisa, I'm enjoying listening, but sure, I'll take the reins from here. I am joined by John, helping us set up a very busy and potentially pivotal week. Let's start with Wednesday. Higher than expected data in the first quarter for inflation. Does that continue this week?
Well, that's one of those things that we're going to have to find out, right? And my own view is that there is what we have referred to as residual seasonality in both the GDP accounts, which has made GDP quarter to quarter appear weaker than it actually is in the first quarter, and the inflation data higher. So I do think there is a good chance that we're going to see a number that ends up being neither fish nor fowl. If we get the 0.3% on core CPI, that is excluding food and energy, that will be a little cooler than we saw in the first quarter, but not cool enough to be at 2%. But the problem is, for me, and when it comes to thinking about the Fed, is they haven't really laid out their methodology for beginning to lower rates, because if we get rate cuts in 2024, and I think we still get 1 or 2 rate cuts this year, it will be a different kind of rate cutting than the Fed has typically done in the past.
And this is something you've been writing about, that they haven't distinguished between cutting rates and an easing cycle. So what is the difference, John?
Well, it's massive. So this concept, real interest rates adjusted for inflation, right? So the Fed's target funds rate's 5.25% to 5.5%. When the Fed started hiking rates, when rates were essentially at zero, and the inflation rate was taken off, real interest rates were very negative. Now we've moved to positive real rates. Now, if inflation continues to decline and the Fed leaves interest rates unchanged, then real interest rates will rise, and the Fed will actually be tightening policy. But it will be tightening policy as inflation heads towards 2%. Now, the tighter policy is, the faster should be the fall in inflation. So the Fed, what the Fed risks doing is undershooting here. Now, the problem is the markets, and this is Powell's problem in the past. He talked about when the Fed starts cutting rates, we typically cut by 5 percentage points. Right. So when he even talked about rate cuts in December for the first time, the market priced in 3 or 4 more additional rate cuts to the 3 that they already had